All right, everyone. It is noon and time for us to start our class today on employee business expenses and other miscellaneous deductions. For those of you who are joining us for the first time, I wanted to let you know that you do need to be on the lookout, listening and looking with your eyes for 3 passwords that I will be putting up during today's class. You need those passwords in order to pass the password test, and the password test proves you attended the video, either the live class I'm teaching now or that you watched the self-paced video if you're watching it as a self-paced course. Throughout the class today, I'm going to be reading from the course manual, and you can download this manual from inside our learning management system, which is called Open Campus. And you just simply need to go back to the course, navigate into the course content, and there is a folder there that contains the course materials, and that's where this manual is. I will be at various times showing you answer keys as well to classwork assignments. And there are also homework assignments, and the answer keys for classwork and homework assignments are loaded in that same materials tab. So during today's class, if you have any questions, you can chat them into the chat box, and I'll answer them as I see them. Okay, so we're on to page 2 of the manual, and page 2 of the manual gets into an introduction of what itemized deductions are and how they compare to the standard deduction. I'm not going to read through that today because we've covered it in earlier classes this week, but I'm going to just draw your attention to one box or one extra sentence that I added to the manual, which says if you decide to itemize deductions, even though they are less than your standard deduction, you're going to need to check a box on line 30 of Schedule A, and then you attach Schedule A to your return. And in our earlier class, we talked about reasons why you might want to itemize even though the standard deduction is a higher number. And if you decide to do that because it benefits you to itemize or you need to itemize for other reasons, then you would have to check that box on the Schedule A. Otherwise, IRS gets confused and thinks you made a mistake, and they might revert you inadvertently to the standard deduction. So let's move on to the next page in the manual where we have an image of the Schedule A. And Schedule A is, of course, used to claim your itemized deductions. Earlier in the week, we covered medical and dental expenses in a 1-hour class. And then in a 3-hour class, we spent about an hour each on the topics of taxes paid, interest paid, and gifts to charity. And then today we had a class on casualty and theft losses, which is another 1-hour course by itself. And finally, we're going to wrap up the Schedule A series with a discussion of miscellaneous itemized deductions. And so we're going to be talking about the lines that appear on this part of the Schedule A. And we're going to be taking a look at line 21, employee business expenses, line 22, tax preparation fees, line 23, other miscellaneous stuff you can deduct. And then we'll also move down to line 28 where we look at miscellaneous deductions that are not subject to the 2% limit. And then we'll finally wrap up the day by taking a look at total itemized deductions and the limit on itemized deductions for certain filers who have income over threshold amounts. And we'll also do a little bit of a summary of how that nasty, nasty tax called the alternative minimum tax can take away all the hard work we do as tax preparers trying to save our clients money. And when it comes to miscellaneous itemized deductions, that's where the AMT comes in at its worst. Today we're going to be talking about all kinds of things we can do to get our clients' deductions increased. Unfortunately, many of the deductions we're going to be talking about today are deductions that the AMT just steals away, and all the hard work can be futile as a result. So let's move on to the next page of the manual, which is page 4. And we're going to begin with an introduction to miscellaneous itemized deductions, just in general. And expenses you incur as an employee or are related to other income productions such as investment or hobby income may be deductible as miscellaneous itemized deductions. You may be able to deduct expenses you incur to produce or collect income that must be included in your gross income, manage, conserve, or maintain property held for producing such income, or to determine, contest, pay, or claim a refund of any tax. You can deduct expenses you pay for purposes in 1 and 2 right here above only if they are reasonable and closely related to these purposes. You can deduct expenses you pay for most common items that you see here, and these include unreimbursed employee expenses for car, travel, meals, entertainment, and education, job search expenses, union dues, tax advice and preparation fees, safe deposit rental when the box contains investment property, hobby losses to the extent of hobby income, and gambling losses to the extent of gambling winning. There's actually a lot more things that can be deducted than what you see on this short list. It's just that these are the most common ones. And we're going to move on now to talk a little bit about the 2% limit. Well, there are a few deductions that are not reduced by income limits. Most miscellaneous deductions are subject to that 2% of adjusted gross income limit. And what that means is that you take all of your income from the front page of the 1040 form, you figure your adjustments to that income, and you get a total number called your AGI. You're going to take that AGI, you're going to multiply it by 2%, and whatever number results, you don't get to deduct that number. And so you take your miscellaneous itemized deductions that are subject to the 2% limit, you subtract that number out, and if you have anything left, you get to deduct it. And that may be harder to do than you might imagine, because although the 2% limit may seem rather small, it is hard for most people to beat it. And here's an example of how it works. Your AGI is $40,000, and during the year, your employee business expenses totaled $600. If you're earning $40,000 a year and you spend $600 for job-related expenses, it probably feels like a pretty good number and you should be able to deduct it. But sorry, 2% of your AGI is $800. That's more than the $600 you spent, and so you get to deduct nothing at all. And that's the way it is for most filers. Now, we are going to be moving on to the first topic of today's class, which is unreimbursed employee business expenses. In fact, it is the major topic of today's class. We're going to be on it for quite a while. But after we finish with employee business expenses, we're going to move on to tax prep fees and then other business expenses. And it's important to differentiate between what is an other expense and what is an unreimbursed employee expense. I mean, it should be self-evident what the difference is. An employee expense is an expense you incur because of your job. You pay the expense to help you do your job more efficiently, to work your way up the chain of financial benefits of, getting more credentials, basically things you do to improve the level of income you're getting because you're in pursuit of taxable income. Those go on the unreimbursed employee business expense line. But other expenses that you might be incurring because of investment income, for example, they go on line 23. So there is a difference. And today we're going to be looking at unreimbursed employee expenses. Now, with respect to unreimbursed employee expenses, you can deduct only unreimbursed expenses that are paid or incurred during your year for carrying on your trade or business of being an employee and are ordinary and necessary. An expense is ordinary if it is common and accepted in your trade, business, or profession. An expense is necessary if it is appropriate and helpful to your business. An expense does not have to be required in order to be considered necessary. You may be able to deduct the following types of expenses as unreimbursed employee expenses. Business bad debt of an employee. Believe it or not, I actually had an employee who was saddled with paying off a bunch of credit cards that he racked up for the benefit of his employer. And the employer basically said, yeah, use your personal credit card to charge all of these supplies, and then I'll reimburse you later. And then the employer went out of business, and the employee was left saddled with that. So it was basically a bad debt that his employer owed him, and he was able to deduct it. Business liability insurance premiums. Damages paid to a former employer for breach of an employment contract. Depreciation on a computer your employer requires you to use in your work. Dues to a chamber of commerce if membership helps you to do your job. Dues to professional societies. Educator expenses. Home office or a part of your home office that is used regularly and exclusively in your work. Job search expenses in your present occupation. Laboratory breakage fees. Legal fees related to your job. Licenses and regulatory fees. Malpractice insurance premiums, medical examinations that are required by an employer, occupational taxes, passport for a business trip, repayment of an income aid payment received under an employer's plan, research expenses of a college professor, rural mail carriers' vehicle expenses, subscriptions to professional journals and trade magazines that are related to your work, tool supplies used in your work, travel, transportation, meals, entertainment, gifts, and lodging related to your work, union dues and expenses, work clothes and uniforms, but only if they are required for your job and not suitable for everyday use, and finally, work-related education. We're not going to cover all of those individual topics today, but we're going to cover a lot of them. And we're going to begin with local transportation expenses. Local transportation expenses are the costs for driving around in the vicinity of your tax home. And typically, most of the local transportation expenses that a worker is going to incur is going to be related to getting to and from work, that daily commute to and from the job. But we've just described the most common type of expense related to local transportation that a worker will normally have, and it's actually a non-deductible expense. Aside from the commute, is there any kind of local transportation that is deductible? And the answer is yes, there is, and we're going to be talking about that now. The cost of getting to and from work is generally not an allowable expense. However, certain local transportation costs are deductible. Local transportation costs include ordinary and necessary costs of all of the following: getting from one workplace to another in the course of your business or profession when you are traveling within your tax home. Also, visiting clients or customers, going to a business meeting that is away from your normal workplace, or getting from your home to a temporary workplace when you have one or more regular places of work. These temporary workplaces can be either within the area of your tax home or outside of the area. But I've got a caution note here for you that local transportation does not include expenses you have while traveling away from home on business overnight. So let's talk about this definition of work location being temporary. So IRS says you can deduct local transportation costs to a temporary work location. And what does that word temporary mean? Well, temporary means that the location that you're going to on a temporary basis will last 1 year or less. And there's a consistency here in what IRS means by temporary, and that is it kind of sinks in with the definition of short term when you're looking at capital gains and losses. In capital gains and losses, if you hold property for 1 year or less, you are considered to have held it for short term. And if you hold it more than a year, it's long term. Well, when we're looking at whether your job location is temporary or permanent, IRS says look at that 1 year or less rule. So if you are assigned to a temporary work location in the local area of your tax home, you may be able to deduct transportation expenses subject to the following. If you have a regular job location and you commute to a temporary work location in the same trade or business, you can deduct the expenses of the daily round trip between your home and that temporary location. If you have no regular place of work but ordinarily work in the metropolitan area where you live, you can deduct daily transportation costs between home and a temporary work site that is outside of that metropolitan area. Now, just to see if you all are with me and are kind of awake as we start this class after the lunch hour, I'd like you to think for a minute and just send me some chats on what you think a good example would be of an occupation where a person would not have a regular work location. Because in order to say you have a temporary work location, that means you have to have a regular work location. So what kind of professions would likely not have a regular work location? A carnival worker. That's definitely an example of a transient. Absolutely, Gordon. Any other ideas? Outside sales, it can be, but you know, outside sales, sometimes those people work from their home and then their regular work location is their home. So outside salespeople they could be, but it's more likely that they actually have an office that they work from, which is in their home. Somebody who works outside the home but is always going to a different workplace every day, or you know, regularly throughout the year will be working at one location and then another location. There's a couple real obvious ones that are in my mind. I can see that you're all kind of, your brains are working but not coming up with answers. Gordon is going for one. And James, let's see. Construction, thank you, Gordon. That was the precise one I'm thinking of, and there's one other. Insurance sales, again, James, I'm thinking anytime you're in sales, usually you have a home office. And so sales, you do have a regular work location. It's usually your home office. The construction, definitely, yes, that would be an example of something where you don't have a normal work location. So, for example, if you're a bricklayer, you're going to go to a construction site and you're going to lay bricks until that particular job is done, and then you're going to go to another construction site and lay bricks till that job is done. And you certainly don't work from your home, and you don't have a regular place that you go to work. So construction worker is an exact example. Now, an airline pilot has a tax home, but would typically go to the airport every day. So an airline pilot is going to have a fixed work location that is the airport that they are attached to. So the commute to and from that airport would be to the regular work location. But the other example I'm thinking about is one that doesn't leap to people's minds, and I think it's a really good one, and that is substitute teacher. If you're a substitute school teacher, the job you do involves going to a classroom and teaching in that classroom a day, a week, sometimes a few months, depending on the reason why you're substituting, who you're substituting for. But most substitute teachers will not have a regular school that they're going to on a daily basis. They're going to be going to different schools all over town and sometimes even different school districts. For example, I have a school teacher that is a substitute teacher, and she literally comes in with 6, 7 W-2s, all of them from different school systems. And even within a single school district, she could be working in multiple schools for that district. So school teachers that are temporary teachers would be a good example of someone who is working outside of the home, would be working within their metropolitan area, but would not have a regular work location that they're going to. Construction workers are another excellent example. But salespeople usually do have a fixed work location. It may be that they go to an office, they check in each day, they're given their appointments for the day. I've been in sales, and I know what it's like. I believe it or not, I sold vinyl siding at one time when I was in my younger years struggling and couldn't make enough money in tax season. And so I actually sold vinyl siding and windows for Sears. And we had a fixed office. We would go to the office every morning. There would be the meeting. We would be getting our appointment lists. And we'd go off and meet with those customers. And so the drive I had from my home to that office location, that was a fixed commute to a fixed work location, and I went there every day of the week. And then when I left that location and drove to the appointments, now I was driving from my regular work location to visit a client or an appointment, a prospective customer, so that absolutely was deductible. Now, I have a brother-in-law who is a shoe salesman. And he works on a W-2 for a single employer, and that single employer is located in a different state than he is, so he maintains an office in his home. And every day when he gets up, his commute is from his living room sofa to his office inside the same house, and that location in his house is his permanent work location. Every time he leaves that permanent work location to go meet clients, then he is, of course, got deductible mileage. So the ones that really stand out as having temporary work locations are those people who don't have a home office, don't have a fixed work location somewhere outside of their home, and yet are usually working in their metropolitan area going to these temporary sites. The rule is that if you have a regular work location and you commute to a temporary work location, then you can deduct the mileage to that temporary work location. But if you have no regular place that you work inside your normal metropolitan area, you are not allowed to deduct mileage that you have from your home to all of these temporary locations inside your metropolitan area. But if you are given a job site outside of your metropolitan area, then that becomes deductible. So let's look at a really good example I have because I've done construction workers for so many years. I have a client who normally works in the metropolitan area of Portland and absolutely prefers to when he can. But when times are tough, the union that he belongs to may find work for him somewhere else. And I'm in the Portland area, so on a number of occasions he's gone up to Seattle and worked on job sites in Seattle for months at a time. So for the period of time he's driving to work sites in the Portland metropolitan area, he gets no mileage deduction at all. But when he takes a job site up in Seattle, as long as it's a temporary site, now he is outside the metropolitan area of Portland. He's driving to a temporary work location somewhere else, and the distance that he's driving is going to be allowed as a deduction. So let's talk now about commute cost. And really what we're getting into with these items right here is that if you have a temporary work location and you also have a regular work location, the distance between home and that regular work location is commute. And when you don't have a regular work location, then IRS says, well, your commute is wherever you happen to drive from your home to that non-regular work location. And the whole thing that we're getting at here is that the IRS does not allow a deduction for commute, and so you're trying to differentiate when you have commute and when you don't. Commute costs are the costs of driving to and from work within your metropolitan area, and commute costs are never deductible. The following transportation is considered to be commute: driving to a temporary job site when you do not have a regular work location. If you do not have a regular job location, you cannot deduct daily transportation costs between your home and a temporary work site within the metropolitan area. These are non-deductible commute expense. Also, driving from your home to a second job. You cannot deduct the cost of traveling from home to a second job, and we're assuming in this sentence that the second job is a permanent job and not a temporary job. 2 places of work. The following rules apply if you work at 2 or more places in the same day. You can deduct the expense of getting from one workplace to the other, but if, for personal reasons, you cannot go directly from one work location to the next, such as a detour to visit your doctor on the way to your second job, then you can only claim expenses equivalent to what it would have cost you to travel directly from one work location to the next. Parking. The fees you pay to park your car at your place of business are non-deductible commute expenses. You can deduct the cost of business-related parking expenses, but that is only the case when you visit a customer or client or you are attending a meeting away from your normal work location. Well, depending on where you live and where you work, parking may or may not be an issue. I mean, if you're working in the suburbs, you've probably got an office complex or a retail location where there's scads of parking and you don't even think about parking. You just find a spot, you park, and it's free. But if you're working in a downtown location or in an area where the parking is metered, then parking may become a big deal. It can become quite expensive. And depending on the city you're in, it could be really expensive. Parking in downtown New York or Los Angeles or San Francisco, hugely expensive. And IRS says, too bad, you can't deduct it. Now, to a certain extent, an employer is allowed to provide an employee with free parking, but there's a limit on the value of the parking that the employer can pay for. And I can't remember that number in my head. I taught it earlier in this series of classes, but it's just not a number I care to remember, and so I don't. But I have a feeling it's like $140 a month or so, or $150 a month, that employer can spend on parking for the employee and give that benefit to the employee as a tax-free fringe benefit. But if the cost of the parking goes over that limit per month, then it actually becomes a taxable fringe benefit included in the employee's wage. Now, whether or not the employer provides free parking to an employee makes no difference in terms of whether an employee can claim the cost of parking themselves. The answer is if you're paying to park at your normal work location, it's non-deductible. But if you're paying to park somewhere away from your regular work location because you are attending a meeting or visiting a client, then it is deductible. So this chart that I'm showing you on the screen right here comes directly from IRS Pub 17. Just going to zoom in a little on it so you can see it better. It's really the perfect way to establish whether or not your distance that you are driving, is it deductible or not. And IRS says start at your home and look at your regular main job. And the distance between your home and your regular job is never deductible. We then look at the drive from your home to a second job, and that's never deductible. Or your home to a temporary work location. But your home to a temporary work location is deductible so long as you have a regular main job. And if you go from a second job to a temporary job, or your regular job to a temporary job, or a regular job to a second job, that's always deductible as well. So let's go through a summary of deductible local transportation expenses, just a comparison here. Commuting from one job to another job in the same day is deductible. Fees for parking while attending a meeting away from your regular place of work is deductible. You can claim the cost of putting an advertisement on your car. You can claim the cost of operating a for-profit carpool, which you operate as a business. You can also claim added costs you pay because you haul tools or instruments to work. But the following on this side of the chart are non-deductible transportation expenses. Commuting to and from your regular job is not deductible. Fees for parking while you are at work are not deductible. If you put an advertisement on your car, that in and of itself does not create a business use for the car. You still have to track whether or not you're using that car for business activities, and if you have an ad on the car and just drive it to work and park it there from home every day, that's not business use of the car. You can deduct the ad, but not the use of the car. You cannot claim the cost of your share of carpool expenses if you pay to travel to and from work in a carpool. And the fact that you haul tools and instruments to and from work in your car does not mean that you are using the car for business. You still have to have a mileage log and you still have to track the use of that car. And finally, union member trips to a union hall are not deductible, and if you prepare tax returns for people who are union workers, it's bound to be the case they're going to ask that question at some point, so you may as well just know, sorry, not deductible. We've determined whether or not the vehicle use is deductible. Now let's talk about how we figure the amount of allowable expense for use of that car. If you use your car for business, you can claim the actual cost of operating the car, or you may be able to claim a standard mileage allowance. Now, whichever method you choose, you must keep adequate records to prove business use of the vehicle. Standard mileage rate. Well, there is a standard mileage rate that is in effect for each year, and it's a pretty darn good deal. I still occasionally have a client that says they want to use actual expenses, but I can never quite figure out why, because it's a lot more work to track actual expenses on a vehicle, and they don't necessarily very often get you a higher number. The standard mileage rate usually is a great number. And right now, for 2014, the standard mileage rate has been 56 cents per mile. And for those of you who are tracking mileage for your clients during the 2015 tax year, we're now at 57.5 cents for each mile driven in 2015. It was interesting because the 2013 rate was 56.5 cents a mile, and then it dropped to 56 cents, and now it's up to 57.5 cents. But gas prices actually aren't up over 13, so who knows where IRS comes up with these numbers. It's supposed to be tied to the cost of driving your car, which has fluctuated with the price of gas considerably. Now, the following rules apply if you want to use the standard mileage rate. You can claim the standard mileage rate instead of the following: depreciation, gas, insurance, lease payments, licenses, oil changes and other maintenance costs, registration fees, repairs, and tires. If you claimed actual expenses on a car that you lease rather than own, you cannot claim the standard mileage allowance in a later year. And if you choose the standard rate, you cannot claim actual costs for operating your car in that same year. Even if you claim the standard mileage rate, you can still claim allowable costs for parking and tolls. You cannot claim the standard rate at all if any of the following are true. You operate 5 or more cars at the same time in your business, because if you do, you're considered to have a fleet, and fleets are required to use actual expenses. Or you claim depreciation deduction other than straight line for the car in an earlier year. In other words, if you used accelerated depreciation on the car in an earlier year when you claimed the actual expenses, you cannot turn around and claim the standard mileage rate in a year following that. Also, you cannot claim the standard mileage rate in any year after a year you claimed the Section 179 deduction or the special depreciation allowance. Or if you are a rural mail carrier who received a qualified reimbursement, you're not allowed to use the standard mileage. And finally, if you claimed actual expenses on a leased car in an earlier year, you cannot turn around and claim the standard mileage allowance on a leased car this year. And finally, when you are claiming the standard mileage, you're going to multiply the number of business miles you drove by the standard mileage rate. So let's look at some actual expenses that you might be claiming if you decided to claim actual expenses instead of the standard mileage rate. So allowable expenses that you can claim if you're claiming actual expenses are depreciation, garage rent and parking costs, gas, oil, and repairs, insurance, lease payments, license and registration fees, repairs and replacement tires, and tolls. Now, even if you claim actual expenses, you must still track the number of business miles you drive so that you can prorate the cost between business and personal use. So it's not uncommon for me to run into clients who think that they should claim actual expenses instead of the standard mileage rate, because if they claim actual expenses, they just have to keep the receipts and they don't have to keep a mileage log. But unfortunately, that's not how it works. Whether you claim the standard mileage rate or actual expenses, you are required to keep a log. And the reason you need to log your mileage is so that you can determine what the percentage business use of the vehicle is. Once you've determined the percentage business use of your vehicle, you're going to multiply that by the actual costs you had for operating it. And so here is an example of what I mean. You drove your car 15,000 miles during the year. 10,000 miles were personal and 5,000 were business. Your actual cost of operating the vehicle totaled $7,000 for the year. You're going to figure your allowable deduction as follows. You're going to take the 5,000 business miles and divide that by 15,000 total miles. And then you're going to multiply that by the total expenses for operating the car of $7,000. When you do that, you get $2,333. Well, right off the bat, that's already a lower number than the standard mileage rate, and that's usually what happens when I look at these numbers. The standard mileage rate of 56 cents per mile times $5,000 is going to give you more than $23.33. If you just take 50 cents a mile and multiply that by 5,000, you're going to get $2,500, and yet we've got 56 cents a mile, so it's just kind of a no-brainer. Pretty much whenever I have a client come along that wants to claim actual expenses, it works out about that way. Now, the exception to that rule is if you've got a client who does not drive a lot. So let's just suppose they're paying lease payments on a car and the lease payments are $600 a month, and they only put 500 miles a month on the car, and 400 of those miles are business miles. That would be a situation where you've got a high-cost vehicle, mostly driven for business, with not a lot of miles being driven. In that situation, you would be better off claiming the actual expenses. But if you're doing any kind of typical mileage on any kind of average car, you're probably better off claiming the standard mileage. So let's look at business versus personal use next. If you use your car for business and for personal, you must maintain adequate records to show your business use. Acceptable methods of tracking business use include keeping a mileage log. The log should record the following: the dates you drove, the places you traveled to, the miles that you drove, and the reason for your travel. You can do that, but you can also use your personal calendar of appointments to log miles driven for your appointments. Well, back in the days when I was a salesperson, I had a log of all of my appointments, and it was sure a heck of a lot easier to write down how far I went in that log to see that appointment than it would be to keep a separate book. So ultimately, that's what I did, and turns out that's allowed by IRS anyway. These days, people are often keeping their appointments on a smartphone calendar. And you could certainly use your smartphone calendar to track your appointments, and at the end of the year, print it all out and use that as a mileage log. That would be totally acceptable as well. Now, you may use actual expenses or the standard mileage rate in any year, so long as you use the standard mileage rate in the first year that your car is available for use in your business. However, if you switch to actual expenses in a later year, following a year you claimed the standard mileage rate, you must use the straight line depreciation method when you figure your actual expenses. So the rule for the standard mileage rate is the car is available for use in your business. The first year that it's available for use, you have to use standard mileage rate. Any year after the year you use standard mileage rate, you're eligible to use either standard mileage or actual, but if you use actual, you have to use straight line depreciation. And then if you purchase a car and the first year you use it in your business is a year where you claim actual expenses, then you cannot revert at a later point to the standard mileage. Interest on car loans. Whether you can claim a deduction for interest you paid on a car loan depends on if you were self-employed or an employee. Employees can never deduct the cost of interest on a car loan as an employee business expense. If you are self-employed, you can claim the cost of interest on your car loan as a business expense on Schedule C. So this is the one that gets people. Car loan interest can be pretty substantial. If you are operating a car as an employee business expense, the interest you pay on that loan is non-deductible. But if you are self-employed, you can claim the interest portion, the business use of that interest that you pay on the car, as a deduction on Schedule C. And that particular rule is spelled out in IRS Publication 463 on page 17. And now we're going to move on to what happens if you sell a car for which you have claimed business use. If you sell, trade in, or otherwise dispose of a car you used for business, you will need to report the disposition of the vehicle on Form 4797, Sale of Business Property. This is because you will need to determine whether you have a gain or loss on the disposition of the vehicle. If you determine that you have a gain or loss in the vehicle, then you're going to need to report that gain or loss on your tax return, and it would be actually ordinary gain or ordinary loss. You must factor for depreciation when you sell the vehicle, even if you claim the standard mileage rate instead of expenses. And here is an example. Jen sold her 1998 Ford Taurus for $3,000. In earlier years, she claimed expense deductions for the car. Since she previously claimed a deduction for business use of her Taurus, she's going to need to report the sale of the car on Form 4797. And one of the things that Form 4797 does is it asks for depreciation previously claimed. And that depreciation that you've claimed is going to reduce your basis in the car. And if you claim the standard mileage rate, there's actually a built-in depreciation component in that figure. And so each year the depreciation component will vary as the standard mileage rate changes in amount each year. And when it gets into figuring out how much depreciation is built into the standard mileage rate, I actually cover that in 2 different courses, Depreciation Made Easy, and also in the course I teach called Sale of Business Assets. Those are coming up later in our series, probably into the first week of June, when we get into depreciation and the sale of assets. Last week of May, perhaps, is when I'm covering those courses. And we'll talk in great depth about how you calculate depreciation based on the standard mileage allowance. And then in sale of assets, we do the same thing again. Let's look at illustration number 2 here. You have another type of disposition of a car. Jan totaled her 1998 Ford Taurus. The vehicle was not insured, and she received no payment for scrap value. Since Jan previously claimed a deduction for business use of her Taurus, she must report the disposition of her car on Form 4797. Next one up, we have travel expenses. So we've been talking about the car and how you deduct expenses on your car, standard or actual. Now we're going to move on to travel expenses. To claim travel expenses, you must have a regular place of abode in a real and substantial sense. And you have a regular place of abode if all of the following is true. You work in the same vicinity as your claimed abode, and you use it while you're doing business. Also, your living expenses incurred at your claimed abode are duplicated when you're away on business, and you have not abandoned the vicinity in which your place of lodging and claimed abode are both located, or you have a family member or members, marital or lineal, currently residing at your claimed abode, or you use that claimed abode frequently. Your tax home is your regular place of business or post of duty, regardless of where you maintain your family home. It includes the entire city or general area where your main place of work or business is located. So for most people, tax home and family home are one and the same. But it is entirely possible to have a family home in a different place than your tax home. For example, I live in the city of Portland, Oregon. And an hour south of Portland is the city of Salem. There are people who live in Portland and commute to work in Salem. Salem is the tax home for those individuals, even though their tax home is in a different city, Portland. And when you have that type of situation, traveling from Salem to another work location is when you are traveling away from your tax home. And traveling from home in Portland to another location could also be interpreted as business mileage, but you're already away from your tax home when you're in your home city if your home city and your tax home are different places. The IRS does want to make it clear that although tax home is typically where you live because you normally live where you work, it is possible that your tax home is in a completely different place than where you normally live. Now, you can claim the cost of expenses you incur when you travel away from your tax home overnight. But if you do not have a regular place of business or post of duty and there is no place that you regularly live, you are considered to be a transient, and your tax home is wherever you happen to work. As a transient, you can never be away from your tax home, so your travel expenses are never deductible. So earlier in the class today when I was asking who doesn't have a regular work location, and I was given the answer of carnival worker, well, carnival worker is a person that has no regular tax home, whereas a construction worker typically would have a tax home. The construction worker is usually going to be working in the vicinity or within the boundaries of a particular city, and that city represents their tax home. They don't have a regular job location, but they do have a tax home. And you compare that to a carnival worker that's always traveling from one location to another. You could make the argument with a carnival worker that they have no regular work location, and therefore they can never be away from their home. One could also argue that the carnival trailers that they're living in are their home, right? And since they're taking their home with them, then the cost of taking your regular home wherever you go is not going to be deductible. So literally what we're looking at when you're trying to deduct travel is you have to establish that you've got a regular tax home, a place that you normally work. And now you're traveling somewhere else and you're duplicating the cost. So not only are you maintaining your regular work location, you're also paying for duplicate costs to live somewhere else at the same time. And it's that duplication of costs that becomes deductible. So again, you must have a main place of work. If you have more than one place of work, consider the following when determining which one is your main place of work. The total time that you ordinarily spend in each place, the level of your business activity in each place, and whether your income from each place is significant or insignificant. Traveling away from home. you are traveling away from home if your duties require you to be away from the general area of your tax home for substantially longer than an ordinary day's work, and you need to sleep or rest to meet the demands of your work while you are away from home. The rest requirement is not satisfied merely by napping in your car. You do not have to be away from your tax home for a whole day or from dawn until dusk, as long as your relief from duty is long enough for you to get necessary sleep or rest. And here are a couple of examples that come out of IRS Publication 463. You are a railroad conductor. You leave your home terminal on a regularly scheduled round trip between two cities and return home 16 hours later. During the run, you have 6 hours off at your turnaround point where you eat 2 meals and rent a hotel room to get necessary sleep before starting the return trip. You are considered to be traveling away from home. Example number 2, though, doesn't qualify. You are a truck driver. You leave your terminal and return to it later in the same day. You get an hour off at the turnaround point to eat. Because you are not off to get necessary sleep and the brief time is not adequate as a rest period, you are not traveling away from home. Temporary assignment or job. If you are temporarily assigned to a job at a location away from your tax home, you can deduct your temporary living expenses as travel expenses subject to the following. Your assignment must be considered temporary in order for you to claim the expense. A temporary assignment is one that you realistically expect will last 1 year or less, and in fact does last 1 year or less. If your assignment is indefinite, that is expected to last more than a year, the location of the assignment becomes your new tax home and the cost is not deductible. So let's just think for a little bit about how you could have an assignment that is indefinite. Let's just suppose your normal tax home is San Francisco. And you've been working in that regular tax home area for a long enough period of time that you know it's your tax home. And now you're given a temporary assignment in, let's say, Sacramento. The temporary assignment, though, is indefinite. We're going to send you to Sacramento. We don't know if it's going to be 6 months or 2 years. We need you to handle a situation there. And if it all works out well, we're going to keep you on. The fact that there's no set end to that period at the time you accept the assignment means that it is indefinite. And if it's indefinite, then it becomes your new tax home. And in effect, you will end up having to move there. And you could deduct moving expenses of moving from San Francisco to Sacramento, but Sacramento would not be considered to be temporary. But let's take the situation and change it up a bit. Let's suppose you are living in San Francisco. San Francisco is your tax home, and your employer says to you, we need you to go work at a location managing a store for a 6-month period while the regular manager is on maternity leave. When she returns, you're going to come back, and the anticipated length of time is 6 months. So that would be an example of where you know there is a definite end to the period of time you're going to be there. Probably you'd maintain your home in San Francisco while you were working in Sacramento, and if you did that, you could deduct your expenses for living in San Francisco because you would be duplicating expenses while you were in Sacramento. But let's look at it a third way. Let's suppose you go from working in a regular job location in San Francisco, and you are given a 6-month assignment in Sacramento. And you say, well, 6 months is long enough that I don't want to pay rent on 2 locations at the same time for 6 months. So I'm going to end the lease that I have, and I'm going to bring everything I have with me to Sacramento. And when I'm finished this temporary job in Sacramento, then I'll go back and find a new place because I wanted a new place anyway. Well, now you're in a situation where you can't deduct the temporary expenses again because you can only deduct expenses when you are duplicating them. And if you don't maintain a residence in your normal work location and instead move out of your normal residence, stop paying rent there, and take up a new location somewhere else to live in for 6 months, now you're not going to have temporary living expenses because you're not duplicating those expenses. So determining temporary or indefinite. To determine if your travel is temporary or indefinite, you should apply the following rules. If you are indefinitely assigned to a work location, that work location becomes your tax home. You must determine if your assignment is indefinite or temporary when you start your job. You may claim temporary living expenses while you are away from home up until the date you first become aware that the assignment has become indefinite or will last more than a year. Members of the armed forces who are on permanent duty assignment overseas are not traveling away from home, and naval personnel assigned to ships with eating and sleeping facilities are considered to have a tax home aboard ship for travel purposes. If you are on a probationary assignment with the understanding that you will keep your job upon satisfactory completion of the probationary period, then your assignment is considered to be indefinite for travel purposes. So what about going home on your days off? This time we're looking at Pub 17, page 176. If you travel home on days off to visit your family, you can claim travel expenses equivalent to what meals and lodging would have cost you had you stayed in your temporary home. This rule applies only if you are assigned to a temporary work location that is away from your tax home. If your temporary assignment is expected to last more than a year, you cannot claim the cost of expenses that you pay for your temporary home or meals. Now note, if the assignment away from your family home is indefinite or is expected to last more than a year, then you cannot deduct any costs associated with traveling to your family home on your days off. However, if you travel away from your tax home to the vicinity of your family home for legitimate business reasons, then you can deduct the cost of business travel to the vicinity of your tax home. And again, this came from Publication 17, page 175. So I'm trying to think of an example that would pick this one out here. I'll use one that I've really had. I had a client who lives in Beaverton, which is a suburb of Portland, Oregon, and he took up an assignment, a 2-year assignment in Seattle. And the wife and kids here in Beaverton said, hey, we're not going to Seattle. Are you kidding me? We got a life here. My friends are here. My kids are in school. We're staying. So husband goes off to Seattle, rents an apartment or whatever he does there for 2 years. And on the weekends, for 2 years, he travels from Seattle to Portland. None of that is travel expense for him because Seattle is his tax home. And every time he leaves Seattle to travel to Portland, that's just personal mileage to go visit his family. But if he had a business trip, in other words, if he had to travel from Seattle to Portland for a business reason, then that would be considered allowable expense. All right, qualifying travel expenses. The IRS considers travel expenses to be the ordinary and necessary expenses of traveling away from home for your business, profession, or job, and the primary reason for your trip must be business. If the trip is primarily for business, you can deduct all of your necessary travel expenses, but clearly you are not going to be allowed to deduct the costs associated with personal side trips or to lengthen your stay for personal reasons. And one of my favorite vacation places is Hawaii, so I have a couple of Hawaiian vacation concepts here. You travel to Hawaii for a convention, and the convention lasts 3 days, but you stay a week to enjoy a short vacation. You may deduct the cost of traveling to and from Hawaii and the costs associated with meals and lodging surrounding the convention. The costs for meals and lodging you incur during your additional vacation time, however, are not deductible. What about if the trip is primarily for personal reasons? Well, if your trip is primarily for personal reasons, you're not going to be able to deduct any of your travel expenses. However, if you incur direct business expenses while you are on your trip, you can deduct those expenses. And here is another example. You travel to Hawaii for a week's vacation, and while you are in Hawaii, you attend a 1-day seminar related to your business. You cannot deduct any of the costs associated with travel to or from Hawaii. You cannot deduct the cost of lodging or meals in Hawaii, but you can deduct the cost of attending the seminar. Additional costs of bringing friends or family members with you. Additional costs you pay to bring friends or family members with you are not deductible. And here is an illustration where the spouse travels with you to Hawaii again. You travel to Hawaii to attend a 4-day seminar, and your spouse decides to travel with you. Because of a 7-day deal you were able to purchase, the cost of staying in Hawaii is for 7 days is the same as if you just purchased and stayed for 4 days. It's probably not going to happen too often, but we could dream, right? Now, you can deduct all the costs for your travel, meals, and lodging for yourself, but you cannot deduct any of the costs associated with your spouse traveling with you. And this is true even if your spouse assists you with performing your job duties. Some people have jobs where spouses are almost expected to travel with them, and there was probably a time in the past where it was a legal deduction, but it has not been the case for many, many years. If your spouse is coming with you, the only way that the expenses associated with that spouse traveling are going to be deductible is if that spouse is traveling for business on a W-2 and is going to deduct expenses independently. Now, we've looked at travel to Hawaii, which is, of course, an American state. Let's talk now about travel outside of the United States. And we need to examine travel that our clients take outside of the United States with a little more scrutiny because the IRS examines foreign travel with more scrutiny. IRS rules governing the deductibility of expenses for travel outside of the United States are different, and they are also more restrictive than for business travel inside of the United States. IRS defines the United States as the 50 states plus the District of Columbia. How much of your travel expenses you can deduct depends in part on how much of your trip outside of the United States was business-related. You can deduct all of your travel expenses of getting to and from your business destination if the trip was either entirely for business or was considered entirely for business. So when is a travel considered entirely for business? Even if you did not spend your entire time on business activities, your trip is considered to be entirely for business if you meet at least one of the following 4 tests, or 4 exceptions, they say. Under exception number 1, you have no substantial control over the trip. The trip is considered entirely for business if you did not have substantial control over arranging the trip. You do not have substantial control over your trip if all of the following apply. You are an employee who is reimbursed or paid a travel expense allowance, and you are not related to your employer, and you are not a managing executive. And you can refer to Publication 463, Chapter 1 for Managing Executive, and Chapter 6 for the definition of related employer. Exception number 2, the travel outside the United States is not more than 1 week. Your trip is considered entirely for business if you were outside of the United States for a week or less, combining business and non-business activities. 1 week means 7 consecutive days. In counting the days, do not count the day you leave the United States, but do count the day you return to the United States. So we have another similarity here to holding period with capital gains. When you're looking at the holding period for capital gains, the IRS says begin counting on the day after you acquire the asset. And when it comes to travel outside of the United States, the IRS says begin counting on the day after you leave the country. So I guess I've been doing this too long, but I noticed those things. Example, your travel outside of the United States was not more than 1 week. You traveled to London on a trip that was primarily for business. You left Austin on Tuesday and flew to New York. Wednesday afternoon, you boarded the flight to London and arrived in London on Tuesday morning. On Thursday and Friday, you had business discussions, and from Saturday until Tuesday, you were sightseeing. You flew back to New York, arriving Wednesday afternoon, and then on Thursday, you flew back to Austin. Although you were away from your home in Austin for more than 1 week, you were not outside the United States for more than 1 week. This is because the day you depart does not count as a day outside of the United States. Your travel expenses are deductible as follows. You can deduct your cost of the round-trip airfare between Austin and London. You can deduct the cost of your layover in New York. You can deduct the cost of your stay in London for Thursday and Friday while you were conducting business, but you cannot deduct the cost of your stay in London from Saturday through Tuesday because those days were non-business activities. Exception number 3, less than 25% of the time was for personal activities. Your trip is considered to be entirely for business if you were outside of the United States for more than 1 week and you spent less than 25% of the total time that you were outside of the United States on non-business activity. And here is an example. You travel for 21 days on a business trip from Los Angeles to Beijing as follows. You spent 14 days on business, and you spent 5 days sightseeing, and then you spent 1 day flying in each direction. Because only 5 of the 21 days, 5 21s is less than 25%, of your total time abroad was for non-business activities, you can deduct as travel expenses what it would have cost you to make the trip if you had not engaged in any non-business activity. The amount you can deduct includes the cost of the round-trip airfare and 16 days of meals subject to the 50% limit, plus the cost of lodging and other related expenses for those 16 days. Exception number 4, vacation was just not a major consideration. Your trip is considered entirely for business if you can establish that a personal vacation was not a major consideration, even if you have substantial control over arranging the trip. So let's take a look now at trip primarily for business. So it was considered entirely for business. We looked at the 4 exceptions that would allow a trip that was not entirely business to be considered as if it was entirely for business. Now we're going to move on to a looser definition here where we get into a determination of whether or not a trip was primarily for business. If you travel outside of the United States primarily for business but spend some of your time doing personal activities, the following rules apply. You can deduct the business portion of your cost of getting to and from your destination. And then you must allocate or prorate other travel costs between your business and personal activities to determine your deductible amount. Travel allocation rules. If your trip outside of the United States was primarily for business, you must allocate your travel time on a day-to-day basis between business days and non-business days. And the days that you depart from the United States and return to the United States are both counted as days outside of the United States. So in the earlier example, the day you leave the United States doesn't count, but when you're looking at the primarily for business test, the day you leave and the day you depart does count. Miscellaneous expense password number 1 is Dolphin. DOLPHIN. When a trip is considered to be entirely for business, the proration is simple. You're just going to worry about the additional amount it costs you to take the trip because of the non-business activity. All of the rest of the travel that you would have incurred anyway is allowed in full. But when the trip is not considered to be entirely for business, then you look to see if it's considered to be primarily for business. If it's primarily for business, you're still allowed to deduct expenses, but the IRS has these formulas and rules you have to apply to determine how much you are allowed to deduct. And they are called travel allocation rules. If your trip outside the United States was primarily for business, you must allocate your travel time on a day-to-day basis between business days and non-business days. The days you depart from and return to the United States are both counted as days outside of the United States. To figure the deduction amount for your round-trip travel expense, use the following fraction. And we've got the total number of business days outside of the United States. You're going to divide that by the total number of business and non-business days of travel outside of the United States. So how do you count the business days? Well, your business days include transportation days, days your presence was required, days you spent on business, and certain weekends and holidays. For a transportation day, count as a business day any day you spent traveling to or from a business destination. However, if, because of a non-business activity, you do not travel by a direct route, your business days are the days it would have taken you to travel a reasonably direct route to your business destination. And extra days for side trips or non-business activities should not be counted as business days. Also, if your presence is required somewhere, then you would count as a business day any day your presence is required at a particular place for a specific business purpose. Count it as a business day even if you spent most of the day on non-business activities. Days spent on business. If your principal activity during working hours is the pursuit of your trade or business, count the day as a business day. Also count as a business day any day you are prevented from working because of circumstances beyond your control. Certain weekends and holidays. You can count weekends and holidays and any other necessary standby day as a business day if it falls between business days. But if the day follows your business meeting or activity and you remain at your business destination for non-business or personal reasons, you can't count these extra days as business days. And here we have a couple of examples. One where the weekend falls between business days and one where it falls after the business day. Your tax home is San Francisco and you travel to Vancouver, Canada, where you have a business meeting on Friday. You have another appointment on the following Monday. Now, because your presence was required on both Friday and Monday, these are business days. And the weekend that falls between those two business days, those 2 days are also considered to be business days, even if you spent them sightseeing, visiting family, or doing other non-business activities. But assume the same facts as in example 1, except that you had no business activity in Vancouver on the Monday. You stayed in Vancouver over the weekend when you could have flown home on Saturday instead. Since there was no business need to stay in Vancouver, the Saturday and the Sunday would be non-business days. Non-business activity on the way to or from your business destination. If you stopped for a vacation or other non-business activity either on the way from the United States to your business destination or on the way back to the United States from your business destination, then you must allocate part of your travel expenses to the non-business activity. The part that you must allocate is the amount that it would have cost you to travel between the point where your travel outside of the United States begins and your non-business destination and a point where you return to the United States after travel outside ends. So you determine your non-business portion of what that expense is by multiplying it by the fraction, and it's the same fraction I showed you earlier. You take the total number of non-business days of travel and you divide that by the total number of days that you spent outside of the United States. And here is an example of what I mean. We have a person who travels on business, and they're doing a direct route from their home in New Jersey to their home in Frankfurt. But on the way home, they don't fly back to New Jersey directly. Instead, they go through London. So there's a non-business stop on the way home. You live in New Jersey on June 12th, and you flew to Frankfurt to attend a business conference that began June 13. Your conference ended at noon on June 21, and that evening you flew to London, where you visited with friends until the afternoon of June 29, when you flew directly home to New Jersey. The primary purpose for the trip was to attend the conference. Now, if you had not stopped in London, you would have arrived home the morning of June 22nd. You do not meet any of the exceptions that would allow you to consider your travel as entirely for business. June 12 through June 22, 11 days are business days, and June 23 through 29, 7 days are non-business days. You can deduct the cost of your meals subject to the 50% limit, the lodging and the other business-related travel expenses for while you were in Frankfurt. But you cannot deduct your expenses while you were in London. That makes total sense. You also cannot deduct 7/18 of what it would have cost you to travel round trip between New Jersey and London. The travel costs were as follows. You paid $750 to fly from New Jersey to Frankfurt. You paid $400 to fly from Frankfurt to London, and you would have paid $700 to fly from London back to New Jersey. So the total cost of airfare was $1,850. Now, the round-trip airfare between New Jersey and London, if you had bought a ticket for that, would have been $1,250. I find it interesting that the IRS has you do this formula. Rather than saying what it would have cost you to fly round-trip from New Jersey to Frankfurt, what would that have been? It asks you, what would it have cost to go New Jersey to London, that's a place that isn't the destination? But that's what they want you to do, so that's what I'm teaching you. You figure the deductible part of your air travel expense as follows. You multiply the cost of the direct round travel to London by the fraction shown below. 1,250 times 7/18 equals 486. And you again get that by taking the number of non-business days during travel outside of the United States, and you divide that by the total number of days outside of the United States. You then subtract 7/18 of the round-trip airfare and other expenses you would have paid in traveling directly between New York and London, that 486, from the total amount of what you actually spent, this $1,850. So $1,850 minus 486 gives you a total of $1,364, and the IRS says you can deduct $1,364. Non-business activity at, near, or beyond the business destination. So in this illustration, we went to a business location and then we took an indirect route back home again. We compare that to this next concept, which is you have a non-business activity that is at, near, or beyond the destination. If you had a vacation or other non-business activity at, near, or beyond your business destination, you must allocate part of your travel expense to the non-business activity. The part you must allocate is the amount it would have cost you to travel between the point where travel outside of the United States begins and your business destination, and a return to the point where travel outside of the United States ends. You determine the non-business portion of that expense using that same fraction, the total number of non-business days outside of the United States divided by the total number of days outside of the United States. None of your travel expenses for the non-business activity at, near, or beyond the business destination is deductible. And here is an example of what we mean. We have a trip from New Jersey to Frankfurt, and then from Frankfurt to Venice, back to Frankfurt, and then back home to New Jersey. It might be smarter to go indirect, go Frankfurt to Venice and then Venice to New Jersey, but this person did Frankfurt to Venice, Venice to Frankfurt, and back to New Jersey, so things aren't as pretty as they were in the London illustration. But assume the facts are the same as in the previous example with the London destination, and instead of going to London for your vacation, you fly to Venice, Italy for a vacation. You had the following travel expenses for this trip. Lodging, meal, and expenses while in Frankfurt, $4,000. Airfare and other related travel expenses from New Jersey to Frankfurt, $1,750, and travel to Venice, $2,000. You cannot deduct the $2,000 of the cost of going to Venice. Not allowed. Makes sense. But in addition, your deduction for the other business travel expenses is going to be limited. You're not going to be allowed to deduct 7/18 of the cost of airfare and other expenses from New Jersey to Frankfurt and back to New Jersey. Also, you can deduct, though, 11/18 of the round-trip airplane fare and other travel expenses from New Jersey to Frankfurt. And you can deduct your meals, subject to the 50% limit, lodging, and any other expenses you had while you were in Frankfurt. So the cost of the airfare from New Jersey to Frankfurt is $1,750, and you're going to be allowed 11/18 of that amount. That gives you an allowable airfare deduction of $1,069. You're also going to be allowed the lodging, meals, etc. while you were in Frankfurt of $4,000, and that's going to give you a total allowable travel expense of $5,069. And bear in mind that the portion of this lodging, meals, etc. that is meals, the deduction is limited to 50% of the meal expense. Other methods, you can use any other method of counting business days if you can establish that it more clearly reflects the time spent on business activities outside of the United States. Now, what happens if the business is primarily for personal? Well, that's kind of self-evident. If you travel outside of the United States primarily for a vacation or for investment purposes, the entire cost of the trip is a non-deductible personal expense. However, if you spend some time attending brief professional seminars or a continuing education program, you can deduct your registration fees and other expenses that you have that are directly related to your business. So the next item of business travel we're going to look at is luxury water travel. I like to talk about how luxury water travel, it used to be the case that everyone traveled from the United States to foreign countries by water because there was no airplanes. You go back in time to 100 years ago, if you wanted to go to Europe, you had to go by boat. And that was the way people got places, by boat. Well, here today in the modern era, of course, most everyone flies. However, the IRS does accept the fact that you could actually travel by boat to a business destination, and that is allowable. So if you travel by ocean liner, cruise ship, or other form of luxury water transportation for business purposes, there is a daily limit on the amount that you can deduct. The limit is twice the highest federal per diem rate allowable at the time of travel as shown in the following table. And it depends on the time of year that you travel. If you travel October to December, the high rate for federal per diem is $374. And if you're traveling by luxury water travel, then the maximum daily amount you can claim if you're traveling at that time of the year is $748. And you compare that to January through February, where the rate drops to $262, and so you would only be allowed to deduct $524 a day if you're traveling by water. And then we have somewhere in the middle, July through August, you would be allowed up to $670 a day for travel by water. And here is an example where the cost of travel by water is greater than the daily limit. Shelley travels by ocean liner from New Jersey to Paris on business in May. Her expense for the 6-day cruise was $5,200. Shelley's deduction for the cruise cannot exceed $4,056 because that's 6 days times the $676 daily limit. That sounds like fun. I'm ready to travel by water to Paris. That would be great. Meals and entertainment. If your expense for luxury water travel includes separately stated amounts for meals or entertainment, those amounts are subject to a 50% limit on meals and entertainment before you apply the daily limit. But if they are not separately stated, then you don't have to allocate any part of the travel expense to meals or entertainment. There are some exceptions. The daily limit on luxury water travel does not apply to expenses you have to attend a convention, seminar, or meeting on board a cruise ship. And if you're attending a convention, seminar, or meeting on board a cruise ship, we've got more rules. For conventions, you can deduct your travel expenses when you attend a convention subject to the following rules. The convention agenda or program shows the purpose of the convention. The agenda is related to your position in such a way that it shows your attendance was for business purposes. You can show that your attendance benefits your trade or profession. You cannot deduct the travel expense for your family. If the convention is for investment, political, social, or other purposes unrelated to your trade or business, you can't deduct it at all. Now, for conventions held outside of the North American area, there are even more restrictions. You cannot deduct expenses for attending a convention, seminar, or similar meeting outside of the North American area unless the meeting is directly related to your trade or business and it is reasonable to hold the meeting outside of the North American area. And this table here shows you what the North American area is. It includes, obviously, North America. It includes Dominica, Honduras, most of the islands out there in the Caribbean. But it also includes waters and areas surrounding United States territories. The North American area also includes U.S. islands, cays, and reefs that are possessions of the United States and not a part of the 50 states or the District of Columbia. Reasonableness test. The following factors are taken into account to determine if it was reasonable to hold the meeting outside of the North American area. So typically, you can only deduct the cost of attending a convention on board a vessel if it's inside the North American area. But it could be that you're allowed to deduct it even if it's outside of the North American area if it meets a reasonableness test. The following factors are taken into account to determine if it was reasonable to hold that meeting outside of the North American area. Firstly, the purpose of the meeting and the activities taking place at the meeting. The purposes and activities of the sponsoring organizations or groups, and the homes of the active members of the sponsoring organizations and the place at which other meetings of the sponsoring organization or groups have been or will be held. And finally, any other relevant factors that you can present. So if there's a reasonableness test that you needed to attend this convention on board this ship and the ship was not in the North American area, and you can show reasonably why it wasn't, then it could still be allowed. Now, once you've gone through all of those tests, there's another deduction limit. Don't get too happy. You can deduct up to $2,000 a year only for the expense of attending convention seminars or similar meetings held on cruise ships. And all ships that sail are considered to be cruise ships. You can deduct these expenses only if all of the following requirements are met. The convention, seminar, or meeting is directly related to your trade or business. The cruise ship is a vessel registered in the U.S. All of the cruise ship's ports of call are in the United States or in possessions of the United States. You attach to your return a written statement signed by you that includes information about the total number of days on the trip, the number of hours each day you devoted to scheduled activities that are business related, and a program of the scheduled business activities of the meeting. You attach to your return also a written statement signed by an officer or organization of the group sponsoring the meeting, which includes a schedule of the business activities of each day of the meeting and the number of hours you attended the scheduled business activities. We're going to pick up with the next subject, which is meals. Unless you meet the rules for business entertainment, you cannot deduct the cost of meals unless it is necessary for you to stop for sleep or rest to properly perform your duties. For your allowable meal expense, you can use the actual cost of meals, or if you are traveling away from home, you can claim the actual cost of meals or the standard meal allowance. So the first thing that IRS is saying here is that when you eat a meal locally within your tax home, it's not a meal expense, it's an entertainment expense. And meal expense, as far as they're concerned, is really something that you have to consume when you're traveling away from home on business. So most of the time IRS feels that meals are not allowable, because you're going to eat at home anyway. You need to be able to establish that you're paying for meals because you can't eat them at home. You're traveling. And the only exception to that is when the meals surround a business activity or such as an entertainment activity where you're wining and dining a client or a prospective client, for example. So let's move on and talk about when you can deduct meals, what you are allowed to deduct. If you are traveling away from home on business, you can claim a standard meal allowance. The standard meal allowance covers the cost of your daily meals and incidental expenses that you incur while you are traveling away from home on business. Incidental expenses include the cost for fees and tips given to porters, baggage carriers, bellhops, hotel maids, stewards, or stewardesses. Also, transportation costs between places of lodging or business and places where meals are taken, if suitable meals can be obtained at the temporary duty site, and mailing costs associated with filing travel vouchers and payment of employer-sponsored charge cards and billings. But incidental expenses do not include expenses for laundry, cleaning, and pressing of clothing, lodging taxes, or the cost of telegrams or telephone calls. So IRS is saying the cost of getting to wherever you're going to eat your meal is typically not going to be in addition to the cost of the meal, unless you can show that you couldn't have the meal where you're normally at. So you're on a business trip and there's a restaurant where you're located at that you could walk to. It's very close by. If that's the case, then you're going to deduct the standard meal allowance or the actual cost of that meal. And if you decide to go with the meal allowance, and then you decide to eat some location where it's necessary to be transported there, then the cost of the transportation to that meal would be included in the standard meal allowance. So it's rather a finite detail that they're saying here. If you read it, it says transportation between places of lodging or business and places where meals are taken if suitable meals can be obtained at the temporary duty site. So if the meals cannot be eaten at the temporary duty site, then the cost of transportation to where you can eat is not part of the incidental. But if you can eat at the temporary duty site, then it is incidental. A lot of information for a tiny difference. But then again, incidental expenses don't include other costs that you might encounter on your trip, such as laundry and dry cleaning. Daily per diem rates, now that we've established that you are traveling away from home and that you are incurring a meal cost and you're paying for those meals, IRS says you can claim the actual cost of those meals, save all your receipts, or you can claim a daily meal allowance. And I'm really surprised at how many clients who do travel don't know anything about the daily per diem allowance until I tell them. It's kind of a fun little secret, you could say, because the meal allowance is actually a pretty good number. It could be that you're a high roller and you like to eat in the finest restaurants and you can afford to eat in the finest restaurants, and so your daily food expense is very substantial. But for most people on business trips, you know, they're grabbing a coffee and a biscuit at Starbucks. They're grabbing a lunch somewhere that might cost $15, and if they go out for dinner, maybe it'll rack up to $30. That would be quite a bit to spend on one person in one day. So to spend more than that means that you're living quite extravagantly or lavishly on your trip. And IRS doesn't really care if you live lavishly. If you're claiming the standard meal allowance, you're going to get the standard meal allowance. But if you decide to go lavishly and claim actual expenses, apparently that's totally fine. The thing is that the daily meal allowance is a good number. It's usually more than what people spend. So let's take a look at that. The daily per diem rate varies according to the city or country that you are visiting, and rates are published by the U.S. government and updated at least annually. If you are traveling within the United States, the continental United States, that's referred to as CONUS, and the per diem rates are revised each year for CONUS on October 1st. For the last 3 months of the year, taxpayers use either the per diem rates in effect for October 1 of the preceding year, or they use the revised rates that are effective October 1 of the current year. Now, for a long time, October 1, we were seeing an increase in the daily per diem rate for U.S. cities. Every year I saw it go up $1 or $2 on each city, and then we hit the Great Recession 2008 and everything just flatlined, and in fact the daily per diem rate in some localities went down. But we've really been on an economic swing up in the last few years. Things are improving, and yet I've still not seen the daily per diem rate change in years. I keep waiting for something to happen with it, so far not. So it's been stuck on the numbers that I'm about to show you for some time. The 2015 standard rate for most areas of the country is $46 a day, and there was no increase when we got to October 1, 2014. We'll see what happens October 1 of 2015. If you want to know what the daily per diem rate is for a high-cost area, you can click on the link that I have in the manual here, and it will take you to a website where you can look up the rates for specific areas in the country. Because although the standard rate for the entire country is $46 a day, it happens to be that most areas of the country where you have metropolitan areas, they're going to be higher. For example, the higher areas can qualify for $51 a day, $56 a day, $61, $66, or even as high as $71 a day. And here are some examples of cities that qualify for $71 a day. We have Los Angeles, Seattle, Las Vegas, Chicago, Washington, D.C. These are all $71 a day cities. Portland, Oregon, Philadelphia, San Antonio are $66 a day cities. Milwaukee, Wisconsin, and Salt Lake City are both $61 cities. The per diem rates for a city may apply to a general region in which the city is located. For example, Phoenix and its suburbs qualify for a $71 daily per diem rate as long as the area that you are in falls inside of Maricopa County. So by going to the link up here, we get to an IRS website, or a government website rather, where you can look up the particular region or area that you are visiting. And in this case, I've just highlighted Phoenix, Scottsdale, which is inside Maricopa County. And if you follow it across, you'll see that the meal and incidental expense rate is $71. So you don't necessarily have to say you're in Phoenix, Arizona, or Scottsdale, Arizona. What you need to do is determine that you were in Maricopa County. And if you weren't in Maricopa County, then you would look up what county you were in. Now, if you're traveling outside of the continental United States, that is outside of CONUS, and outside of CONUS would be any of the American territories as well as Alaska and Hawaii. And if you're traveling outside of the American territories, then you actually go to the U.S. Defense Travel or Department of Defense Travel site to look up rates for areas outside of CONUS that are still considered to be part of the United States. Then we move on to foreign travel, travel to other countries. And if you travel to foreign countries, there's another site again. This one belongs to the State Department, and you can go look up the rates in cities that you would travel to in other countries. When you get into the State Department site, the rate varies according to the city you are in those foreign nations, and it can also vary according to the month. So when you get there, it isn't enough to just land on a particular country. You have to select the correct city within that country. You then have to select the correct month within the year that you're looking for. And here are some examples of where those foreign per diem rates put you. London, one of the most expensive cities in the world. The cost of feeding yourself in London, they're allowing $181 a day for the cost of food. You compare that with the high cost in the United States of $71 a day, it's substantially more. Even if you're going to Malaysia, Kuala Lumpur is $94 a day, Hong Kong $180 a day, and also I've got a rate here for you, the Isle of Kauai in Hawaii. It's outside of CONUS, and Hawaii is higher, $113 a day. I should caution you that when you are referencing the U.S. government website, you will notice that both the lodging and the per diem rates are listed. And you can see here when we look at Phoenix, Scottsdale, there is a rate here. It says maximum lodging by month. And we've got $106 in some months, $133 in other months, $88 in other months. Those lodging rates, your clients who are claiming employee business expenses or self-employed individuals who are claiming travel expenses, they don't get to use those rates. You can just write them off the list. They look exciting, but they can't claim them. If you are traveling and paying your own travel expenses, you are allowed a daily per diem rate for food, but when it comes to the cost of lodging, you actually have to claim the actual cost of lodging. These per diem lodging rates are used by employers who reimburse their employees or give their employees a daily per diem amount to pay for their own lodging. So, for example, if you're working for a high-tech company and that high-tech company sends you to Scottsdale, Arizona to attend a 4-day convention, that employer could just give you $106 a day if you're there in December to pay for your hotel. You could stay with a friend and still get that $106 a day, or you could buy a hotel room for $200 a night and still get the $106 a day. But that $106 a day represents an amount that the employer can just give you as a per diem, and how you actually spend the money is up to you. Whether you keep it or spend it, it is not going to be taxable income to you. So employers can give these types of per diems to their employees, or the employer can actually just pay for the entire cost of the lodging for the employee. It's the employer's choice. But if the employer is giving a per diem, these are the limits on what the employer can give to that employee as a daily per diem. So moving on, per diem rates for the days leaving or returning home. For travel days to and from home for a business trip, you must prorate your standard meal allowance, and you can do so by one of two methods. Method number one, you can claim 3/4 of the standard meal allowance, or method number two, you can use any method that seems reasonable as long as you consistently apply it and it is in accordance with reasonable business practices. So that's the discussion of meals. Now let's look at entertainment, because remember I told you meals are something that the IRS identifies with travel away from your tax home for business reasons. Entertainment expenses could occur when you're traveling away from your tax home, but really we're thinking of them more as something that probably will occur within the area of your tax home most of the time. You can deduct ordinary and necessary entertainment expenses provided they are directly related to business or if they are associated with your business. In order for it to be directly related to business, it has to pass 3 tests. All of these tests have to be true. Firstly, you expect to derive income or some other specific business benefit other than goodwill at some future time, but it is not necessary to demonstrate that you actually received that benefit. And number 2, you actively engage in a business meeting, discussion, or other bona fide business transaction with the person that you are entertaining. And number 3, your principal purpose of the combined business entertainment activity is the active conduct of your business. It is not necessary to devote more time to the business than to the entertainment to meet this requirement. And you can see here I threw in a little cartoon picture of a business meeting going on around a table. They're presumably having a meal and discussing business while they're there. And in that situation, if it took place in a restaurant, that would be considered an entertainment expense. There's a substantial business discussion going on during the entertainment activity, and it would be deductible. The other picture that we have here is of a sports stadium. If the activity is in a sports stadium, it would probably be difficult to engage in a substantial business discussion amidst the roaring crowd. It would not be practical. But even though it's not practical to hold a substantial business discussion during a sporting event, you could still deduct the sporting event if you can show that it is somehow associated with the business. So if your activity does not meet the directly related test, it can still be deductible if it satisfies 2 conditions. Firstly, the activity has a clear business purpose, and the entertainment directly precedes or follows a substantial bona fide business discussion, generally within a 24-hour period. However, circumstances could allow otherwise. So it could be that you're a business executive and you take a prospective client or an existing client out for a round of golf, and you pay that round of golf. And, you know, golf's pretty quiet. You can discuss business while you're on it. It's not a noisy venue. It's possible to discuss business while you're playing golf. But it could be that you decide that you're going to hold that substantial business discussion with your client at your regular business location, and then after that business discussion has concluded, you decide to take them out to the ballpark. Either of those scenarios the IRS would allow as an entertainment expense. Now, there is a limit on meal and entertainment expense deductions. In most cases, the limit is 50% of the expense, but there are certain people who are involved in the transportation industry who can deduct 80% of their expenses. So the 50% limit applies to meal and entertainment expenses only, but if you are a transportation worker, you can claim a higher number. Now, I should caution you that it's been my experience as a tax practitioner that when my clients bring me a list of their expenses, whether they employ a bookkeeper or whether they do it themselves, if they're using QuickBooks, there seems to be a real tendency to lump travel and meals or travel and entertainment into the same category. And you have to be on the lookout for that because, of course, when they've been lumped together, you're going to have to go through the details of those expenses and separate out anything that is meal or entertainment from the cost of travel, because travel costs are 100% deductible, assuming they're for business, whereas meal and entertainment expenses would be subject to the daily percentage limit. Now let's talk about the limit that applies to transportation workers. You can deduct 80% of your business-related meal expenses that you incur while you are subject to Department of Transportation hours of service limits. And these limits typically apply to the following categories of workers: airline pilots and flight attendants, train conductors, and interstate truckers. In addition to being allowed to claim 80% of these meal expenses, workers who are subject to hours of service limits are allowed to use higher daily rates than the $46 an hour daily rate that applies to non-transportation workers. So non-transportation workers are stuck with that $46 a day rate unless they can show they were in a high-cost area. But if you're a transportation worker, you can go with the higher number that you see here, $59 a day for travel inside of CONUS, and $65 a day for outside of CONUS. And again, those two numbers haven't changed in a number of years either. Now, in addition to this 80% rate, I also wanted to point out the AMTRAK Act. The AMTRAK Act is a federal law that impacts how state governments can tax the income of transportation workers. Now, most of the time, if you take up a temporary job in another state, that temporary job is going to be subjected to taxation by that state you temporarily go to work in. So let's just suppose you normally live and work in California, but you're sent on a temporary assignment to Phoenix, Arizona for 3 months. Well, you're in Phoenix and working in Phoenix, you're going to have to pay tax to Phoenix. That's the law, and Phoenix has every right to tax that income because it is sourced to Arizona. They're going to have a right to tax it. But let's compare that to a transportation worker. So for example, a truck driver. He's driving a big rig from one city in one state to another city in another state, and then on to another state again. Is it fair or reasonable to expect that trucker is going to have to track how many hours they worked in each state that they traveled through so that they can then file a tax return with the state that they traveled through? Obviously, it would be ridiculous to attempt to do that. And so beginning in 1990, it was clarified under federal law that these transportation worker wages are only going to be taxed by their home state. And I'm going to give you an example of what I mean here. We have a trucker. His name is BJ, and he is a driver for the shipping company called Bear Transportation Services. And BJ is a resident of the state of Ohio. During his regularly assigned duties, BJ drives a big rig truck on a route that runs from Seattle through his hometown of Coeur d'Alene, Idaho, and then on through the states of Montana, North Dakota, Minnesota, Wisconsin, and finally into Illinois. Even though a substantial portion of wages that is earned by BJ can be attributable to time worked in other states, BJ's wages are going to be entirely associated with the state of Idaho, and they will not be subjected to taxation by the states that he travels through while he's performing these duties. So I just did a little map quest here for you, and we see the long drive, and Idaho is somewhere in about here. Yeah, this is Washington. Somewhere in about here is Idaho. It sticks up in this panhandle. So that time in Idaho is, even though most of his time is spent somewhere other than Idaho, he's going to be all taxed for Idaho under the AMTRAK Act. And the next item we're going to look at is business gift expenses and the $25 limit. You can deduct up to $25 per year, woohoo, per client for the cost of gifts that you give in the course of your trade or business. I've been doing taxes since 1993, and I can tell you it's always been $25. It's never been adjusted for inflation. And what you could buy for $25 20 years ago is a lot less than you can buy for $25 today. So we're pretty much down to a nice bottle of wine these days that you can give someone valued at $25 or less. But it is still possible to give a gift costing $25 or less. There is an exception to this $25 a day gift rule, and here it is. You give the person an item that costs $4 or less, and it has your name clearly imprinted upon the gift, and it is one of a number of similar items that you widely distribute. For example, pens, desk sets in plastic cases, coffee cups with the company name on them, right? Those are the types of things that can be given away, and the gift limit of $25 a year would not apply. Also, signs, display racks, or other promotional material to be used in the business premises of the recipient. And by the way, a gift given to the family member of your client is considered to be a gift given to that client. And I have a little poll here to see how well you all are grasping this concept. I'll slide it off to the side, and it's really this class exercise that you see right here. It says, Jacob gave the following unreimbursed expenses during the year. He gave Mike, his business client, a $15 gift, and then he also gave Mike's wife a $15 gift. And then there were 4 staff members of a corporate buyer, and you gave $100 worth of gift to those 4 staff members. You can say it averaged out at $25 per staff member. And then there was Janice, who is a business client, and you gave her a $75 gift. So the total gift expense that you had for the year was $205. And my question for those of you in the class today is, what is the allowable deduction that can be claimed by Jacob on his tax return? So let's see what y'all came up with. 3 of you responded, and you all agreed that the gift deduction would be $150. So let's see if that is the correct answer. And I actually have the correct answer written sideways here in the manual. And that is the correct answer. So you did good. You were paying attention. Mike and his wife are going to max out at $25. So you can see here that the value of the gift given to Mike plus his wife is $30. But they are treated as a single person, and so the gift is going to be limited to $25. The 4 staff members at $25 each are allowed in full. And then this gift to Janice, that $75 is going to be limited to $25. So that is how we arrive at the correct answer, which is $150. All right, work-related education expenses. You may be able to claim work-related education expenses as an adjustment to income, as an education credit, or as a miscellaneous itemized deduction on Schedule A. But to be deductible on Schedule A, the education expense must be required by your employer to keep your present salary status job, or it must serve a bona fide business purpose, or it must maintain or improve skills needed in your present line of work. Even if these tests are met, you cannot claim a deduction for education costs if they are needed to meet the minimum educational requirements of your current profession, trade, or business, or they are part of a program of study that can qualify you for a new profession. Education expenses can be claimed in more than one way, and obviously you cannot duplicate them. You should use whichever method you are legally entitled to that saves you the most money, but you can't typically duplicate them. Now, if you are able to deduct your expenses on Schedule A, what can you deduct? Because when we're looking at education expenses, say for an education credit, usually you're limited to the cost of tuition and fees. You're certainly not going to be allowed the cost of transportation. But when we're looking at Schedule A, it's more broad. For Schedule A, you can claim the cost of tuition, books, fees, supplies, and similar items. You can also claim the cost of certain transportation and travel, other educational expenses such as research costs, typing costs. Under transportation, if you are going to school on a temporary basis that is 1 year or less, you can deduct the cost of traveling from work to school and from school to home. But if you're going from school to that school for more than a year, you can only deduct the cost of going directly from work to school. You should claim your unreimbursed education expenses as you do other unreimbursed expenses, and generally you should claim your expenses on Form 2106 or 2106EZ. However, you do not need to file Form 2106 if you were not reimbursed for any of your education expenses and you are not claiming travel, transportation, or other meal expenses. And here is an illustration of when Form 2106 is not required. You paid $6,000 for tuition and other college fees related to your current occupation. You were not claiming any automobile expenses, and your employer did not reimburse any of your expenses. You are not required to file Form 2106, and you can report your employee expenses directly on Schedule A, line 21. Special rules for teachers. If you are a teacher, the following rules apply. Teachers get special treatment, in other words. Once you are considered a teacher under the rules for your state, additional education required by your state to keep up your job is considered to be qualifying education. You are allowed to deduct it. Once you've met the minimum education requirements for your state, you are considered to have met the minimum education requirements of any other states you go to work in later on. All teaching and related duties are considered the same general kind of work. A change in duties in any of the following ways is not considered to be a change to a new business. If you are an elementary school teacher to a secondary school teacher, that's allowed. Teacher of one subject to teacher of another subject is allowed. Classroom teacher to guidance counselor or classroom teacher to school administrator are also allowed. And there's a huge difference between being a classroom teacher and running an entire school district, but it's considered to be the same profession. Claiming the educator expenses, if you claim your educator expenses, you're going to enter them either directly on Schedule A or 2106 if it's otherwise required. You're going to multiply your AGI by 2% and subtract that 2% from the cost of your education. You are also allowed to claim depreciation on computers, but in order to claim the cost of a computer through depreciation, you're going to need to be able to show that the cost of buying that computer was for the convenience of your employer and is required as a condition of your employment. So what does for the convenience of your employer mean? Well, it means that you have a substantial business reason for purchasing that computer. It isn't enough that your employer requires you to have the computer, although usually your employer would only require you to have a computer because it's necessary for it. But it is possible that you could have a job where you purchase a computer just to use for your business and it's not allowable. And the IRS gives an example of that here. You are an engineer in an engineering firm and you occasionally work from home at night rather than late at the office. You own and use a computer that is similar to the one you use at the office to complete your work at home. Since the use of the computer is not for the convenience of your employer and it is not required as a condition of your employment, you cannot claim a depreciation deduction for it. So essentially, just as a handy tool, you happen to buy a computer so you can occasionally work on it from home. It would be difficult to argue that it's even exclusive use in a position like that. It seems to me that to buy a computer that you only occasionally use would be a rare instance, and IRS in any event throws this out and says no. Now, if you are able to show that the computer is used for business, there is a business purpose for having it, you can depreciate it. You don't just take it as an expense, you depreciate it. And if the computer is used more than 50% for business, you can claim a Section 179 deduction on it, but if it's used 50% or less for business, then typically you are going to be limited to alternative depreciation system, straight line on it. Now, there is an exception to that rule, and that is if you maintain that computer in a dedicated business office, even including a home office, and you use it exclusively for that purpose, then you don't have to show that it's more than 50% business use, but it would be difficult to have a computer not 100% business use if it's in a dedicated office. So it's kind of, they're taking the rule and giving it to you and then taking it back, if you ask me. Work clothes and uniforms. You can deduct the cost and upkeep of work clothes if the following two requirements are met. You must wear them as a condition of your employment, and the clothes are not suitable for everyday wear. This is a favorite one. My clients love to come in and ask me if their business suits are deductible. You see this one here? I bought it just the other day, decided I needed something better color for camera for teaching these classes. It's not deductible. It's suitable for everyday wear. I bought it only for work. I don't intend to wear it anywhere else, but tough. And this is the type of thing clients are going to come up with. They're going to say, yeah, but I bought it for this. I need it for my job. Looking good is important, and it doesn't matter. What the IRS does allow is clothing that is literally unsuitable for wearing for any other purpose. And examples of work clothes that they do allow would be delivery worker clothes, firefighters, healthcare workers, law enforcement officers, letter carriers, professional athletes, transportation workers, musicians, and entertainers can also deduct their theatrical clothing and accessories as long as they are not suitable for everyday wear. Protective clothing, you can deduct the cost of protective clothing required in your work, such as safety shoes or boots, safety glasses, hard hats, and work gloves. And examples of workers who might be required to wear safety items include carpenters, cement workers, chemical workers, electricians, fishing boat crew members, machinists, oil field workers, pipe fitters, steam fitters, and truck drivers. So what kind of clothing doesn't qualify? Well, clothing that is suitable for taking the place of your regular clothing does not qualify as business expense. It is not enough that you wear distinctive clothing, nor is it enough that you do not, in fact, wear your clothes away from work. And the following are examples of work clothing that is not deductible. A painter is required by his union to wear a white cap, white shirt or white jacket, white bib overalls, and standard work shoes. This clothing is not distinctive in character, and it is not a uniform. Also, blue work clothes worn by a welder at the request of the foreman is not allowed. Military uniforms. For the military, most military people are not allowed to deduct their uniforms, but they have some exceptions in here. If you are an armed forces reservist, you can deduct the unreimbursed cost of your uniform if military regulations restrict you from wearing it except while you are on duty as a reservist. In figuring the deduction, you must reduce the cost of any non-taxable allowance you receive to pay for the uniform. Fatigue uniforms. If military rules do not allow you to wear fatigues when you are off duty, you can deduct the amount by which the cost of buying and keeping up these uniforms is more than the uniform allowance you receive. My husband was a Navy pilot, and he had a flight suit, and he was not allowed to wear the flight suit off base. So he would put it on at home and get in the car and drive to work, and if he had to get gas on the way to work, he'd have to go to a full-service gas pump because he wasn't allowed to get out of the car and be seen in public wearing this flight suit. So that would be an example of something that's not suitable for everyday wear, but it's still a uniform. And that's what the IRS is getting at with this fatigue thing. Student at an armed forces academy, you cannot deduct the cost of your uniforms if they replace regular clothing. However, you can deduct the cost of insignia, shoulder boards, and related items. And finally, civilian faculty or staff member at a military school, you can deduct the cost of your uniforms if you are a civilian faculty or staff member of a military school. Job search expenses. These are a little bit like education expenses. You can only deduct education expenses for your current profession. You cannot deduct expenses that qualify you for a new profession. And with job search, they got the same darn rule. You can deduct certain expenses you have of looking for a job in your present occupation, even if you do not get a new job. but you cannot deduct these expenses if you are looking for a job in a new occupation. There is a substantial break between the ending of your last job and the fact that you are now looking for a new one, or you are looking for a job for the first time. Employment and outplacement agency fees. You can deduct employment and outplacement agency fees you pay looking for a new job in your present occupation. And if an employer pays you back, though, and reimburses you for those employment agency fees, you must include the amount you receive in your gross income up to the amount of tax benefit in the earlier year. And if the employer pays the employment agency, then you don't need to include what that employer paid the employment agency in your income. You can deduct the cost you pay for preparing and mailing copies of a resume to prospective employers if you are looking for a new job, again, in your present occupation. And travel and transportation, you may be able to deduct travel expenses you incur because you travel to an area to look for work. The following facts should be considered in determining if the travel expenses are allowed. Whether the trip is primarily to look for a new job and the amount of time you spend on personal activity compared to the amount of time you spent looking for work. Even if you cannot deduct the travel expenses to and from the area, you could still deduct expenses of looking for a new job, again, in your present occupation. Home office expense. Home office expense is a pretty challenging one. There are very few employees who can deduct home office. In order for an employee to deduct home office, they have to show that it is the only place that they can perform their job. In other words, their employer doesn't provide them with an office, and the employer is, for the employer's convenience, telling them to work from home. If your employer offers you an office or a fixed work location that you can go to and says you can work from home if you choose to, that's completely different than your employer saying you must work from home, we don't have a place for you. The situations where I see people working from home and not being given offices provided by their employers are often people who are involved in sales. Sometimes you're going to have computer programmers who work from home. They can work from home and do everything remotely, and they might even be in a different city than their employer. Those types of situations are allowed. But if you really have a regular work location and you could go to it, but you choose to work from home for your own convenience and not at your employer's request, then it's not going to be allowed. So here are the tests for claiming a home office. It has to meet all of the following tests. It must be your principal place of business for your trade or business, or a place to meet or deal with your patients, clients, or customers in the normal course of your trade or business, or a separate structure not attached to your home which you use in connection with your trade or business. Reporting business use of your home. Now, when you're filling out a Schedule C or a Schedule F and you're claiming business use of home, the IRS actually provides a form. It's 8829. But when you're filing business expenses and claiming them as an employee on Schedule A, there actually isn't a form. So you really have to figure your home office deduction using the same rules that would apply if you filled out 8829. So you could just go ahead and complete 8829 as if it was a worksheet and then save it with your records. If you do that, the IRS, you're just ultimately carrying your net deduction to the 1040 Schedule A or to Form 2106 if it's otherwise required. I have a worksheet here that comes from Drake Software, and it says worksheet for Form 8829. If you go through and look at the computations going on it, they're identical to what goes on Form 8829 that would be attached to your return for, say, self-employment, but you wouldn't attach the worksheet to the return. Reporting employee business expenses. You must complete Form 2106 or Form 2106EZ and attach it to your return if you claim any of the following types of expenses: auto, meal, entertainment, travel, or because your employer reimbursed you for some or all of your expenses. So if your employer did not reimburse your expenses and you had business expenses that are not one of these four kinds of expense, the form is not required. So an example of an expense that the form would not be required for is depreciation, say you bought a computer, or education, or union dues, or supplies that you might use for your job. Those are all examples of deductible costs that are employee business expenses, but are not required to be entered on Form 2106. But once 2106 is required, then you would report all of your employee expenses on it. So let's now look at accountable versus non-accountable plans, because when it comes to claiming employee business expenses, if your client gets audited, the IRS is going to be all over this accountable, non-accountable plan stuff. An accountable plan is a plan where your employer requires that you bring to them your receipts and they reimburse you for those receipts. Or they require you to keep a mileage log, you turn in your mileage log, and they reimburse you for your mileage. That is an accountable plan. You account to your employer for every expense you have, and your employer reimburses you. It can also be an accountable plan if your employer gives you money to spend on expenses, maybe gives you $500 for the month, and says this is the most that we're going to give you. If you spend less than $500, you need to refund us the difference. If you spend more than $500, you're going to have to eat the rest. So that is also an accountable plan. It's in writing, and your employer is requiring you to account for every dollar that they give you. A non-accountable plan is where an employer would just give you an allowance. Just say they give you $500 a month. You can keep it or spend it. They don't care what you do with it. If they're giving you an allowance of $500 under a non-accountable plan, then that $500 is actually a form of compensation to you, and they have to factor that into your W-2. If your normal salary is $50,000 a year plus $500 a month under a non-accountable plan, then your employer should W-2 you for $56,000 for the year. 500 times 12 is another $6,000. So any payments an employer makes to you under a non-accountable plan are taxable compensation to you, and if you are reimbursed under a non-accountable plan, or if you are given an allowance, rather, under a non-accountable plan, you're going to track all of your expenses, and they are going to be deductible in full. And if your employer reimburses you under an accountable plan, and you report everything accurately to your employer, then your employer would include nothing in your income, and you would deduct no expenses, assuming you were reimbursed in full for everything. So there is this table here that I've put in the manual. I'm not going to read it to you, but in a nutshell, it says that if you are reimbursed under an accountable plan, everything is precisely accounted for, you're reimbursed in full, but you keep nothing beyond what the cost of your expenses were, then your employer will include nothing on your W-2, and you will report nothing on Form 2106. And the opposite of that is under a non-accountable plan where you report nothing to your employer reports anything it gives you in your income as wage, then you would file Form 2106 and you would claim all of your expenses on that form. And it's possible to be somewhere in the middle as well. And I'm going to give you an illustration where we have a person who is in the middle. They are under both an accountable plan and a non-accountable plan at the same time. And our character in this story is named Sally Smith. She is a union representative, and her employer gave her a $200 monthly auto allowance, plus reimbursed her 14 cents per mile. During the year, Sally drove 14,000 business miles, 2,500 commute miles, and 20,000 total miles. Her round-trip daily commute was 10 miles. She also spent $500 on deductible entertainment expenses, and her employer reimbursed her $250 for these expenses. Since Sally is given an allowance and she is also being reimbursed, she is under both an accountable and a non-accountable plan at the same time. The $200 allowance that she receives each month is paid to her regardless of the number of miles she drives. She is not required to refund the excess, and therefore the allowance is provided under a non-accountable plan. The 14 cents per mile reimbursement is paid only when Sally submits receipts and a monthly expense report, and the reimbursements are provided under an accountable plan. So let's complete Form 2106 for Sally so we can see how these numbers play together. We're firstly going to look at the amount of mileage she incurred. She drove 14,000 business miles, and the standard mileage allowance she can claim for that car is 56 cents per mile. So when you go 56 cents per mile times 14,000 miles, that's a $7,840 expense that she is allowed to enter on line 1 in column A of Form 2106. She also had some meal expenses that she incurred. She incurred $500 of meal expense, and that's going to go in column B. Then we move down to step 2, and in step 2, we enter the amount of reimbursement she received. Her employer gave her $200 a month, but did not track how she spent the money. And so the $200 per month would be grossed up on her W-2. It would be an extra $2,400 a month of taxable compensation that would appear on her W-2. So the only amount that she's going to enter as an employer reimbursement on line 7 is going to be 14 cents times 14,000 miles, and we get $1,960 when we do that. So we subtract $1,960 from $7,840, and we end up with an allowable expense for her of $5,880. She was also reimbursed $250 of her meal expense by her employer, so that $250 is entered as a reimbursement in column B, We subtract it from the $500, and that leaves her with an allowable expense of $250 for meals. She needs to apply the 50% limit. That reduces her expense for meals down to $125, and she's going to add $125 to the $5,850, and her allowable deduction to carry to Schedule A is going to be $6,005. Now moving over to the next part of the form in Part 2, because she drove her car for her business, she's going to need to report information about the vehicle. And the IRS wants to know the date it was placed in service, the total number of miles driven, the number of miles that were business miles. It wants to know the percentage business use. It wants to know the round-trip daily commute and the total number of commute miles, and also the total number of miles not used for business or commute, entered on line 17. And then finally, the form wants to know the answers to these questions. Was the vehicle available for use in off-duty hours? Do you or your spouse have another vehicle available to you? Do you have evidence to support your deduction, and is the evidence written? Those are mandatory questions, and they must be completed. And we're going to move on to the next topic briefly. We're just finishing up the concept of employee business expenses, but interestingly, we're on to a different kind of employee called a statutory employee. And statutory employees get some special rules. The big rule with statutory employees is that if you are one, you don't complete Form 2106 and you don't deduct your expenses on 2106 at all. Instead, you would claim your expenses on Schedule C. If we jump over to page 61 of the manual, you will see that there is a box here. In box 13, it says statutory employee, this box. It's not very common for it to get checked. In fact, it's so rare that it's checked that it could be checked and you may not notice it. Or if you did notice it, you may not know what it means. But it's a pretty important box, because if it's checked, it means that the client you're working with is a statutory employee, and as a statutory employee, their expenses are deducted on Schedule C rather than on Form 2106. So let's just bounce back to where I was on page 41 and learn a little bit about statutory employees. If the statutory employee box is checked on your W-2, then you should claim your employee business expenses on Schedule C rather than on Form 2106. A statutory employee can include an individual who is employed in one of the following occupations: certain agent and commission drivers, full-time life insurance sales representatives, certain home workers performing work according to specifications furnished by the person or organization for which the services are performed. And that would be, for example, an individual who may be sewing clothing or making, backpacks or something that they're basically constructing them at home. They're being paid on a unit basis by the specifications of the manufacturer, and those individuals are considered to be statutory employees. And then finally, certain traveling or city salespersons working full-time except for sideline sale activities for a single firm or person soliciting orders from clients or customers. If your tax client falls into one of those categories and they meet all of the provisions surrounding the rules for being a statutory employee, then their employer should check the statutory employee box. So if you meet the definition of a statutory employee, your employer must indicate this classification by checking box 3 on the W-2. And this tells the IRS that you have the right to report your expenses on Schedule C. By claiming expenses on Schedule C, the employee is not subject to the 2% limit and does not need to itemize deductions. As a statutory employee, you are considered an employee for Social Security and Medicare purposes. However, if you and your employer agree, federal income tax withholding is optional rather than mandatory. A statutory employee reports his or her wages on Box 1 of Form W-2 and carries that from line 1 of the Schedule C. So the employee would take Box 1 wages from the W-2 and report those as income on the Schedule C, and then all of the expenses are claimed on the Schedule C, and the net profit, instead of being carried to line 12 of the 1040, is carried to line 7 of the 1040 and is reported as wages. Self-employed business expenses. If you are an independent contractor or you are self-employed, you should claim your business expenses on Schedule C and don't complete Form 2106. Performing artists. If you are one of those categories of people that is defined as a performing artist, or rather a starving performing artist, then you can deduct your expenses on 2106, not subject to the 2% limit, but it's very limited. And to be considered a performing artist that qualifies for this special treatment, you must meet the following tests. During the year, you performed services for 2 or more employers, and you were paid at least $200 by each of those 2 or more employers. Your related performing arts expenses are more than 10% of your income for performing those services, and your AGI cannot be more than $16,000 before you perform those services. If you are a minister who has received a tax-free housing allowance, you must reduce your deduction for employee business expenses by the percentage of your income that is not taxed because it was used for housing. So what this means is most ministers, in administering to their flock, have substantial expenses, and they track those expenses. But they're only going to be allowed to deduct expenses on 2106 as a prorated amount based on how much of their income is being taxed in the first place. If a minister receives a housing allowance, for example, of $10,000 a year, and their regular wage is $40,000 a year, then the amount the church is giving them is $50,000 a year, except that $10,000 of the $50,000 is not subjected to tax. So they'll have a W-2 showing $40,000 of wage, but they'll have $50,000 of income. And in that situation, 20% of the income is not being taxed, and so the IRS would say you'd only be allowed to deduct 80% of the expenses associated with the taxable income. Armed Forces Reservist, if you are a member of a reserve component, such as the United States Army, Navy, or Marine Corps Reserve, or the Air Force or Coast Guard Reserve, when you travel away from home overnight and you travel more than 100 miles away from home overnight, you can deduct your expenses for that overnight travel on the front page of 1040 as an adjustment to income. You would complete Form 2106, figure your deduction, and then you'd carry it to the front page of the 1040 rather than to Schedule A. So let's look at a summary here of the type of employee business expenses that people have and how they go about claiming them. If you are claiming meal and entertainment expenses, travel expenses, or auto expenses, Form 2106 is required and you do need to complete it. If you are paying for expenses as a college professor, then Form 2106 is used only if you include meals, travel, or auto expense in those calculations. But if Form 2106 is not otherwise required, then those college professor research expenses could go directly on Schedule A. Job search expenses, they are not allowed when you are looking for your first job, but if your job expenses are allowable and they include anything from meals, travel, or auto, then they would go on 2106, otherwise carry to Schedule A. Educational expenses, they cannot qualify you for a new profession, and they must improve your job skills. If they meet those requirements, you can enter them directly on Schedule A unless Form 2106 is otherwise required because you are claiming meal, travel, or auto. Office use of home. It must be for your employer's convenience and be your only work location. If you're claiming a home office expense and Form 2106 is not otherwise required, you would complete a worksheet, figure the deduction, carry it directly to Schedule A. If 2106 is required, you'd figure the deduction and enter it on 2106. Dues paid to sports clubs or other socially based facilities, these are not deductible. So club memberships are never deductible. And this has been the case since early on in the Clinton administration. That particular benefit was lost. Union dues, business liability insurance, damage for breach of contract, dues to chambers of commerce and professional societies, licenses and regulatory fees, occupational taxes, repayment of income aid payments, and tools with a lifespan of 1 year or less. These are all deductible straight on Schedule A unless Form 2106 is otherwise required. Depreciation on equipment or computers that you buy, or larger tools costing over a couple $100 that have a useful life of more than a year, those are going to be deducted on Form 4562, or the deduction is figured on Form 4562, and then the deduction that you figure will either carry to Schedule A or on to 2106 if it is otherwise required. Military uniforms for active duty personnel generally are not deductible, but if you're talking about fatigues, they are deductible to the extent they exceed any military allowance you are given for them. Military reservist uniforms are deductible to the extent you are not reimbursed by the military and the clothing cannot be worn while off duty. Record keeping is always an important topic. The IRS in Publication 463 on page 27 actually provides this particular table, and it describes the type of record keeping that needs to be done for each category of expense. For example, if you are traveling, the IRS wants you to account for the cost of each separate expense for travel, including lodging and meals and incidental expenses that are totaled into reasonable categories such as taxis, fees, tips, etc. The IRS wants to know the date you left and returned from each trip and the number of days on each trip that were spent on business. It wants to know the destination you went to, the name of the city, town, or other designation, and it wants to know the purpose of the trip and the benefit that you expected to gain. When we go through the other categories of entertainment, gifts, and transportation, it's all looking for similar information, and you can see that each of these record-keeping activities is an activity that goes on Form 2106. So if you attach Form 2106 to your return, and you are selected for audit, there's going to be some scrutiny going on for these categories of expenses. And believe me, they'll scrutinize the education expense as well. I went through an audit one time with a client who was paying for a master's program. He was a salesperson. I said to him, why are you paying for this degree? He said, well, I'm getting a master's in marketing, and I'm in sales, and, it might help me be a sales manager one day. There's no specific requirement for my employer, but it does help me on my job. He was selected for audit. We went to the audit, and the auditor was all over this education expense. It was just driving me crazy. And I'd made a deliberate decision to claim an education expense rather than a credit because Oregon doesn't have a credit, and by claiming an education expense on Schedule A, he was going to get a better deduction on the state. But on the federal, it actually made no difference. And this was a federal audit. So we were in this audit going round and round and round about how it was related to work and whether he had an accountable plan at work, and he was going to have to track down the written plan from his employer, and on and on and on we went until the auditor finally determined, oh, well, if you claim this as an education expense on 8863 as the lifetime learning credit, it would make no difference. So she totally lost interest in the entire subject, allowed the deduction, and we moved on. But it was just a really irritating expense what the hoops were that she was going to demand he go through had she not all of a sudden dismissed the topic in the first place. So here are some important record-keeping tips. If you are claiming business expenses, you need to keep your receipts. It is wise to charge your gas and other business expenses to a different credit card than you use for personal purposes. That way it's easier to track and separate the business expenses from your personal expenses. I tell my clients to keep an envelope in their car where they can put the receipts every time they purchase something for cash or with a credit card, because you tend to go into a store, you buy something, you stick the receipt in your pocket, it piles up in there with keys, it gets all mangled, it gets thrown out, and they have no record. So I recommend they keep an envelope in the car, a big manila envelope stuffed in the door of the car, and every time they have a receipt, they stuff it in there, or maybe they keep it on the kitchen counter in a slot somewhere in the kitchen, but some place where that they are, automatically stashing this stuff. I also tell my clients that they should maintain these records for a minimum of 3 to 7 years, and it's very often the case they throw them out as soon as the year is over. Oh, that year's done, I'm going to throw them out. The reality is if they're going to get audited, they're usually going to get audited a year after the year they file and possibly 2 years after they threw out that receipt. So they need to hang on to them. And finally, the IRS will look at a canceled check as proof of payment of an expense, but they also want to see some other evidence of the expense in the form of a receipt. So it's usually not enough just to have a receipt, and it's usually not enough just to have a credit card statement or a bank statement. The bank statement proves money went out, and the receipt shows what the money was used for. And the IRS typically wants to see both of those things in coordination with each other. They can accept only one or the other, but they like to see both. Tax preparation fees are the next line. We've finally made it off line 21, and we're moving on to line 22 of Schedule A. We're looking at tax preparation fees, and these are deductible on line 22, but if you put them on line 22, they are subject to a 2% limit on your income. And very often tax preparation fees would be the only deduction client might have in this section of Schedule A. But one of the reasons why tax preparation fees can be higher is because the client you're preparing a return for has a business return that's attached. Perhaps they have a Schedule C that you're preparing or a Schedule E for a rental property. And ours says that to the extent you can show that a tax preparation charge was for one of those business activities, you can actually claim the portion of the tax prep fee that was for that activity on the Schedule C or the Schedule E. So if I'm preparing a client's return and I charge them $500 and it's got a Schedule A, a 1040, a Schedule E, and a 4562, I'm going to easily be able to show that the Schedule E and the 4562 are for the rental property, and the next year the fees for those two forms are going to go on the Schedule E, and the balance of the return would go on the Schedule A. Other expenses that are subject to the 2% limit, so we've passed line 22 now, and we're looking at this line 23. So what are some of the deductions subject to the 2% limit that you can claim that we've not already talked about up here on line 21? So that's the next topic. other expenses that are subject to the 2% limit. Certain deductions not associated with employee expenses may be deducted on Schedule A, and following are some of the other miscellaneous expenses you may be able to claim as itemized deductions. Miscellaneous expenses are divided into two categories. There are expenses that are subject to the 2% limit and expenses that are not subject to the 2% limit. And we're going to talk about the 2% limit ones first. IRS Publication 529 describes expenses that may be deductible, and many of which are described in the table shown on page 47 of this manual. The following expenses are subject to the 2% limit. The first one we have is losses on IRAs. You can claim losses on your IRA and Roth IRA investments subject to the rules discussed next. The loss is subject to the 2% limit on AGI allowed. Allowed losses are added back to taxable income for purposes of calculating the AMT. For traditional IRAs, if you have a loss on your traditional IRA investment, you can claim it, but only when all amounts in your traditional IRA have been distributed to you and total distributions are less than your unrecovered basis of any. So let's just suppose you had non-deductible contributions you made to your IRA totaling $10,000. And it was a really bad investment, so you decided to empty out your IRA and you only got $8,000 back. We're not allowed to take a deduction for the amounts you put into the IRA because your income was too high and you had a pension plan at work. We talked about all those rules in another class on adjustments to income. But at any rate, you have a cost basis in that IRA, and your cost basis is 10 and you pull 8 out. You've got a $2,000 loss. The IRS says you can deduct that, and it would be subject to the 2% limit, and you would claim it on line 23 of Schedule A. Also, Roth IRAs, of course, all Roth IRAs always have a cost basis in them because contributions are non-deductible. Same deal there. If you empty out your Roth IRA and you have a loss, you can deduct it subject to the 2% limit. So let's look at some other deductions you might be able to claim that are subject to the 2% limit. We have appraisal fees for donated property or to compute the cost of a casualty loss. Another class that we've had today is on casualty losses, and when you're figuring a casualty loss, you have to reduce the loss that you were allowed to claim by 10% of your adjusted gross income. And one of the requirements for claiming a loss is that you may have to do a valuation of your property, pay an appraiser to come in and tell you what it's worth as a result of the casualty. Whatever amount you pay to that appraiser is going to be subject to a whole new limit, the 2% limit. It doesn't add in and become part of the casualty. Casualty or theft loss of business property used by you as an employee. If you lost property through casualty or theft and it was employee business use property, then the loss is deducted on Schedule A subject to the 2% limit rather than being subjected to the 10% limit. Excess deductions of estate are allowed. Legal expenses paid to purchase or collect taxable income. Depending on where that legal expense is, you might deduct it on Schedule A. So if you were collecting alimony and paying an attorney to collect alimony from your ex-spouse, that would be an example of income that would be reported on the alimony line of your tax return, and then you would deduct expenses for the attorney on Schedule A. But if you pay legal expense, say an attorney related to your self-employment, your business, then that legal fee would go on Schedule C, and if it was related to your farming activity, it would go on Schedule F. Losses on deposits with insolvent or bankrupt financial institutions, those go on Schedule A, line 23, or Form 4684 as a casualty or theft loss. Investment fees and expenses, clerical help, and office rent connected with investment income, fees to collect interest and dividends, service charges on dividend reinvestment plans, trustees' administrative expenses for IRAs, but only if the fees are paid from non-IRA sources. Safe deposit box used to store taxable income, producing documents, and finally, indirect deductions of partnerships and S corporations and non-publicly offered mutual funds all go on line 23 of Schedule A. Then we have repayment of Social Security benefits that is more than $3,000, and repayment of income, we have repayment of Social Security benefits that is greater than the benefits you received, but less than $3,000 out of pocket for the year. So if the Social Security benefits you have coming in for the year are 10 and you repaid 12, then you'd be net out of pocket 2, and that would be deductible subject to a 2% limit. But if you received 10 in for the year and you paid back 15, then you'd be out of pocket 5, and you would be allowed to deduct that not subject to the 2% limit. And a repayment of income of $3,000 or less is deducted on Schedule A, line 23, subject to the 2% limit. Also deductible on line 23 are hobby expenses to the extent of hobby income, and losses on the complete distribution from traditional IRAs, as well as a convenience fee charged by the credit card processing company that you use to pay your income tax bill. So you should know that it is possible to pay your taxes with a credit card, but the IRS does not pay that processing fee for you. You have to pay it yourself, and the IRS says you can deduct that processing fee on line 23 of your tax return. So let's talk now about deductions that are not subject to the 2% limit. You can deduct the items listed below as miscellaneous itemized deductions. They are not subject to the 2% limit, and report these on line 28 of Schedule A. Firstly, we have amortizable premiums of taxable bonds. We also have casualty and theft losses from income property such as stocks, vacant land, and works of art. Now, if you have a casualty loss on personal property, that is subject to a 10% limit and is claimed on Schedule A. But if the casualty loss is related to income-producing property, but it is not property that would be considered business like a rental property or self-employment, but it is income-producing property, then it is deductible on Schedule A, not subject to the 10% limit, the 2% limit, or any limit at all. It would be subject to a 0% limit. And what you would do is you would complete Form 4684 for casualty and theft losses, and you do Section B of the form as if it was a business activity, and then you carry it to line 28. Federal estate tax on income in respect of a decedent. Gambling losses up to the amount of gambling winnings, but you are required to keep an accurate diary of your wins and losses. Impairment-related work expenses for individuals who have physical or mental disabilities. Repayments under claim of right that are greater than $3,000. And repayment of Social Security benefits that is greater than $3,000. In both these situations, those repayments are deductible on Schedule A, not subject to the 2% limit, and you may also be able to figure and claim a credit instead. Unrecovered investment in an annuity on the final return of a decedent. Officials employed by a state or local government on a fee basis. But these individuals claim their expenses on 2106 and then carry them to the front page of 1040 and claim them as an adjustment to income. They don't go on Schedule A, line 28. Also, travel expenses of a reservist or National Guard member who travels more than 100 miles from home. These expenses are not subject to the 2% limit, but they also don't get entered on Schedule A. They carry again to the front page of the 1040 as an adjustment to income. And finally, losses from Ponzi-type investments. These are treated as a casualty loss, not subject to the 2% limit. You would complete Form 4684 Part B, that is page 2 of the form, and then carry the loss to line 28 of Schedule A. Let's talk briefly about gambling losses up to the amount of gambling winnings. You must report the full amount of your gambling winnings for the year on Form 1040, line 21, and then to the extent that you have winnings, you are allowed to claim losses. But you are supposed to keep good records of your losses. And the IRS has quite a system in here to catch people who maybe aren't keeping as good a track of their losses as they want. And I can remember many, many years ago working with a guy. I think he was a gambling addict, but he called himself a professional gambler. He would go off to the horse track and bet on the ponies. And when he won, he'd go around and talk to all the people who had lost money on the ponies and get their receipts, right? So he'd always have this huge bag of receipts for his losses. So you can see that people could be doing that, and so the IRS has systems in place to make sure that people are tracking their own losses and not, scooping up losses from other people. So you must keep an accurate diary or a similar record of your losses and wins, and your diary should contain at least the following information: the date and type of your specific wager or wagering activity, the name and address or location of the gambling establishment, the names of other persons present with you at the gambling establishment, and the amount that you won or lost. And then proof of wins and losses. Typically, when you have a win, you're going to be issued a W-2G, but certain amounts don't have to be reported on W-2G if they're below a certain level. And then IRS goes on to say record-keeping suggestions, the type of thing that you need for each form of gambling. I'll leave you to read through these on your own, but there are rules specific to the types of record-keeping IRS wants to see done, depending on whether you won at Keno, slot machines, table games, bingo, the horse races, or lotteries. They all have different requirements that IRS wants to see followed. Let's talk now about repayments under a claim of right, because although this is a relatively rare one that I run across, it does pop up certainly more than gambling losses. I think that this comes up for me more than I have people come up to me and say they won and then they lost. And it's a pretty significant piece of information. If you had to repay more than $3,000 that you included in your income in an earlier year, because at the time you thought you had an unrestricted right to it, you may be able to deduct the amount you repaid or take a credit against your tax. For more information, you should refer to IRS Publication 525 under the category of repayments. But I'm going to give you an example of a claim of right repayment, precisely like what I've seen clients of mine have. In 2012, Ethel was unable to continue working after succumbing to the effects of a debilitating medical condition. She was covered by a disability insurance program through her job that was fully funded by her employer. Under the terms of the disability contract, Ethel can claim disability benefits only if she cannot receive benefits from Social Security. She applied for Social Security benefits, and the Social Security Administration denied her claim, which is totally normal. So she began receiving taxable payments from her employer's benefit provider. And those benefits, when they are issued on a W-2, and they usually have a code J, and the taxable part is reported in Box 1 as wages with a code J to indicate its disability. For 2012 and 2013, Ethel reported $35,000 of taxable disability benefits as wage income on her tax return. Then in 2014, Ethel received a lump sum payment from the Social Security Administration in the amount of $40,000 after she successfully appealed her claim. Under the terms of the disability contract, she must repay $35,000 of disability benefits she received in the earlier years because she successfully received her Social Security benefits. Ethel repaid $35,000 to the insurance company after receiving her Social Security benefits. The $35,000 is a claim of right repayment. You're going to report that repayment on line 28 of Ethel's Schedule A, and as an alternative to deducting the expense on Schedule A, she may be able to claim a credit instead. And if you want to look up how to calculate the credit, refer to Pub 17, page 92. Losses from Ponzi-type investments, I mentioned that already, that if you are the victim of a Ponzi-type investment, it is treated as a casualty loss, but it is not subject to the 10% or 2% limit, and you can read more about Ponzi scheme losses on these IRS website links that I've put in. And then finally, unrecovered investment in an annuity. A retiree who contributed to the cost of an annuity can exclude from income a part of each payment received as a tax-free return of the retiree's investment. And we actually cover the tax-free return of investment in annuities in an earlier course in our series called Pension and Social Security Income. And in that course, we get into how you figure the simplified method to determine how much of a return you're getting each period. But what IRS says is that if the retiree dies before receiving or recovering all of their investment back, then any unrecovered investment can be deducted on the retiree's final income tax return. And for more about that, refer to IRS Publication 575 on pension and annuity income. The next thing we're going to look at is the limit on itemized deductions. So we've been through all of the different lines on Schedule A over the last couple of days, looking at what can and cannot be deducted, what limits apply. We're finally getting to the bottom. We're going to total up all of our deductions. But we're not done. And if our income is over a certain level, then the IRS is basically going to take away some of those deductions. So beginning in January of 2013, itemized deductions for taxpayers with adjusted gross incomes above $150,000 may be reduced. This $150,000 figure is pegged for inflation, and so for 2014, the number that we start at is actually $152,000, and for 2015 it will rise to $154,000. But in 2013 it was $150,000 that we started at. If your income exceeded that number and you were married filing separate, then a phase out of your itemized deductions begins. Now, if your filing status is any status other than married filing separate, then higher phase-out thresholds apply. For a single person for 2014, it's $254,200, and for a married couple filing a joint return, it's $305,050. If your adjusted gross income is higher than the threshold amount for your filing status, the IRS is going to take away some of your deductions. It's not a rapid progression. It's actually a pretty slow progression. So a person earning $600,000 is still going to be able to deduct most of their expenses. And the most that the IRS will ever take away is 80% of your deductions. So at the very minimum, you'll always be able to deduct 20% of your itemized deductions. because the most the IRS can take away is 80%. So let's talk about the types of deductions that are limited. Firstly, if you claim a deduction for taxes on Schedule A on line 9, those can be limited. Also, deductions for mortgage interest and other types of deductible interest you paid, gifts to charity, job expenses, and most other miscellaneous deductions, and other miscellaneous deductions claimed on line 8 with the exception of gambling, casualty, and theft losses. Now, which Schedule A deductions are not limited? Well, they do not limit medical and dental expenses, investment interest expense, non-business casualty and theft losses, casualty or theft losses from income-producing property, and gambling losses up to gambling winnings. How do you figure the limit on itemized deductions? Well, you take the total of all of your itemized deductions, and then you take your adjusted gross income and you multiply it by 3%. You take 3%, subtract it from your itemized deductions, and you get what's left. But, of course, you have to divide your itemized deductions into categories which are affected and are not affected by this limit. So to show you how that works, I've got an illustration here. And in this illustration, our character is Hugh Grant. His adjusted gross income is $300,000. He's single, so he's going to be just shortly into the phase-out range for a single filer. We're going to figure his allowable itemized deductions based upon the following deductible expenses. And we have two tables here. The first table shows his deductible expenses, and the second table shows the expenses that are actually allowed on Schedule A after figuring for any limits. We have medical expenses of $20,000, state income tax, personal property tax, mortgage interest, investment interest expense equal to investment income, non-cash charity, real estate taxes, cash charity, tax preparation, hobby expenses equal to hobby income, and gambling losses equal to wins. So his total deductible expenses are $75,000. But for medical, we're going to have to reduce his medical expense of $20,000 by 10% of his AGI. His AGI is $300,000, so he gets nothing. And when we go down to tax preparation, we have to apply a 2% limit. And the hobby expenses have to apply a 2% limit on his AGI. And once we've done that, those deductions are zero as well. So once you've zeroed out due to the limits on those specific deductions, his allowable itemized deductions that he's entered on Schedule A are going to total $53,000. So let's go over now to the Schedule A and fill it out. And you can see here on line 1, we've entered $20,000. Net deduction 0. Under taxes paid, we've entered all of the different taxes that he paid and carried the total onto line 9, $24,000. Home mortgage interest on line 10 is $20,000, and investment interest on line 14 is $1,000. The total is $21,000. Gifts to charity, cash and non-cash, totaled $6,000. And then we move down to the bottom of the form where we can see his tax preparation fees and his hobby expenses. After reducing his deductions by 2% of his income, he gets nothing. And then finally, we have gambling losses of $2,000. And so that's the total of all his deductions. Now, when we looked up here at this table showing what we think his deduction should be, we get $53,000. But when we go down to the bottom of the table, we say, oh, that's only $51,626. Why did my software take away numbers? You probably haven't noticed if it did, but it did, and here's why. We're going to take the $53,000 of total deductions that he has, and from that we're going to separate out the amount that has to do with the gambling loss as well as the investment expense. So the investment interest expense was $1,000, and the gambling losses were $2,000. We total those up, $3,000, and we subtract those from his total itemized deductions. We're left with $50,000. We then take line 3 and multiply that by 80%. And when we do that, we get $40,000. The next step is to take his adjusted gross income of $300,000, and from that we subtract the base amount for his filing status. It's pre-printed on the form, $254,200. The difference between line 5 and line 6 is $45,800, and we multiply that by 3%. When we do that, we get $1,374. We subtract $1,374 from $50,000, and then we add in the $3,000, and that's where we get $51,626 of allowed expense. Now, the IRS has a whole bunch of things you are not allowed to deduct at all. They fall under the category of things that people try to deduct, but IRS says no way to. There's a whole list of them here that I'm going to leave you to read on your own. And then I'm going to go down to the very last quick topic of the day, which is the alternative minimum tax. So by the time we've gone through Schedule A and factored all of the deductible amounts and figured all the limits on those deductible amounts and then applied a further limit because our AGI was over a certain amount, now we're still dealing with the alternative minimum tax. And you could say that the alternative minimum tax is a direct assault on Schedule A. It's doing everything it can to take away tax savings that occur under the regular tax on Schedule A. And the lines of Schedule A that are most directly targeted, I'm going to go back in here, are, too big a zoom. This line right here, line 9, any number entered on line 9 is gone under the AMT, not allowed. And you can see for this particular filer, it's a big number. Interestingly, the AMT does not touch the home mortgage interest deduction. That is the holy grail of tax deductions as far as I'm concerned, because it's allowed under both the regular tax and the AMT. Charity is also allowed under the regular tax and the AMT, but these miscellaneous itemized deductions, under the AMT, they are taken away. So not only do you have to deal with the 2% limit on income, you also have to deal with the limit on itemized deductions, and then finally you have to deal with the limits under AMT. But let's look specifically at what AMT targets. It targets more than just Schedule A. It also does not allow deductions for personal exemptions. It does not allow the standard deduction. It does not allow certain types of accelerated depreciation. It does not allow some kinds of losses because it applies its own AMT calculations to certain losses. And it will tax other kinds of income that aren't normally taxed under the regular tax. For example, if you have employee stock options that you purchase, you can pay tax under the alternative minimum tax on income that you haven't even earned yet. So there are a number of different things that AMT does to increase the taxable income that a filer has. And if you have one of those types of incomes, or you took advantage of some of the deductions that are not allowed under the AMT, that's when you become subjected to the AMT. And in order to be subjected to the AMT, however, you have to have income above certain amounts. And these numbers are not terribly high. For 2014, if you're married filing separately and your alternative minimum taxable income exceeds $41,050, you could be paying the alternative minimum tax. For average single filer, it's $52,800, and for married filers, it's $82,100. Now, thanks to the Taxpayer Relief Act of 2012, for the first time in history, the alternative minimum tax is permanently pegged for inflation. So we already know what the inflationary adjusted amounts will be for 2015, and there will continue to be inflationary adjustments in the future. Thank goodness for that, but I still consider the AMT to be one of the nastier things out there and something that really needs to be done away with. And if you want to learn more about the AMT, I have a class that I teach called Understanding the Alternative Minimum Tax. So here we are at the top of the hour. Our day is done. Let me give you the final password for today's class. Middle Earth. MIDDLEEARTH. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.